We've been waiting for vaccines. We've been waiting for the supply to pick up, and supply is exploding.
We're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained?
We've taken wealth from the public sector and we've given it to the private sector.
The Fed believes they have flexibility.
In this world of great uncertainty, if you're pushed by what happens in 1 or 2 meters, you really haven't got the plot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up a single point. Tom Keene, your estimate, 858,000.
Not my estimate. I got it right once, John, like 10 years ago, and I vowed never again to make the guesstimate. You know, the office pool, the kind of thing. Lisa bought 5,000 square feet.
Do you want me to restart the show, Tom?
No, but Lisa...
Tom, equity futures up a single point. The median estimate in a Bloomberg survey, 858,000.
He's just going to keep it going.
8,000. You know, I'm sorry. The standard error is huge. Lisa bought 5,000 square feet on the Upper West Side because she got the pool right 3 months in a row.
Thank you. Do you want to continue? Do you want to get into this market?
We need to put our job today, John, is to put in perspective how important this jobs report is and how nobody has a clue what it's going to be.
Well, let's start doing that right now. The range is 1.2 million at the top end, 350K at the low end. Once again, wide. We've been playing this game now, Tom, on a monthly basis for the last 6 months.
We've been playing it this way because, John, of medicine, and I was in a cab in New York City yesterday, and the cab driver was adamant that the reason you don't see more cabs on the street in New York is they're home on unemployment.
Plenty of demand. Lisa, will we get that supply?
Yeah, that has been the question. Just to do a brief fact check, I did not buy 5,000 square feet on the Upper West Side.
Sorry.
And I also did not win the office pool. Going forward, I think the big question has remained why there hasn't been a faster flood of people into the labor market. People do blame the enhanced unemployment benefits. However, even in the states where you have seen those roll off early, you have not seen an increase in the number of people seeking jobs, at least by a study by Indeed.com. Highly uncertain, which is the reason why there is such a wide range here, John.
Lisa getting up an hour early this morning. You take a break, Lisa. I'll rattle through the price action. Take a breath. Equity futures up a single point on the S&P and run.
All right,
your bond market looks like this. Yields up 2 basis points on a 10-year to 124.32. Going into payrolls, the median estimate in a Bloomberg survey, 858,000. Do I need to do this for the next 90 minutes?
Please
2 hours and 30 minutes.
Yeah,
huge range, Lisa, going into this. Euro dollar 118.10, negative 0.2%.
Okay, so that's the uncertainty with respect to the data itself, which, as you said, we are getting an 8:30 a.m. that July payrolls report.
I didn't know that.
But the key issue is how will the market respond, right? I mean, we've been talking about this for weeks, the idea of what happens, let's say, if it's an upside surprise. How big of an upside surprise does it have to be for the Federal Reserve to start thinking about tapering? And then what? Do long-term yields rise or do they fall based on the fact that sooner taper means slower long-term growth? We will parse this all out for the next day, for the next week, for the next month. Meanwhile, at 10 a.m., President Joe Biden is planning to come out and speak about the jobs market, about the jobs report. Key question I have is how much is he going to spin this forward to the infrastructure vote over the weekend? How much is going to say, look, we need to create the jobs, we need to create the fundamental infrastructure for this country? How much will he lobby for that, and how much will he signify some sort of unity in the Democratic Party with the reconciliation bill sort of hanging out there as well? 1 p.m., the Baker Hughes rig count comes out. This, to me, is one of the more interesting features of this recovery. We have seen discipline from the shale patch. They have not come back online with their rigs as quickly as some people would have expected, given how much we've seen the prices rally. How much has that changed as we get a period of stalling out, one of the biggest weekly declines in oil prices of the year, as people take a look at Asia and the resurgence in virus cases over there, John? Something that a lot of people are looking at. Does discipline hold?
What time does that come out? 1 p.m.
1 p.m.
Eastern time. Lisa, thank you.
It's in the middle
the start of
surveillance
Bloomberg
snap.
Real Yield on Bloomberg TV.
Oh,
we
it is. Yes,
that
it
for
is.
you.
That's very good.
Crude down by more than 6 percentage points this week. It's been rough. It's been ugly. Let's bring in Steve Whiting, Citi Global Wealth Chief Investment Strategist and now Chief Economist as well. Steve, congratulations on the new role. Let's talk about the new seat. Let's put that cap on. Chief Economist over at Citi. What are you looking for today?
Well, we're looking for a strong employment report for the month of July. But I would tell you that this message you're getting from the bond market, that there are somewhat larger risks beneath the surface, that the pace at which growth and employment rebounded in the first half of the year is not going to be sustained in the second half of the year. I bear in mind that this Delta variant we're taking fairly seriously here in the United States. As you saw, hopefully it will be a very short-term surge, as we saw in the UK, but we have seen half of the job gains in the year to date occur in the hospitality and leisure sector. That's just one sector that can, in fact, be impaired in the back half of the year. So again, what you said about the employment data being so critical, so important, just take a look. There'll be numerous headlines at the surface that are important here. And what happens in August and beyond, is really what markets should focus on.
Stephen Whiting, Catherine Mann owns the high ground on trade and international economics. You own the high ground on linking the American economy to corporate finance and corporate profits. The big surprise has been how corporations have adjusted to this to deliver earnings. With your economic view, do you suggest corporations will continue to be malleable and will continue to adjust towards profit and cash flow?
Well, adaptability across the economy has been absolutely amazing. I mean, there are small pockets of distress. I mean, again, in hospitality and leisure, if you're a worker in that sector, there's no joy. International travel, still incredibly weak, and it has been trying to rebound. But for the most, the economy, the empty cubicles that you've seen across the country, it has not stopped. Technology has really, really allowed companies to adapt. And we've had, more than 50% EPS growth in the first half of the year. Now, that cannot accelerate from here. It has to decelerate from here. But is our ability to continue to grow and muddle through and get past this crisis, I think, a pretty good story? I think it is a good story.
Stephen, when we hear about the uncertainty in the labor market, it really raises a question about why we've seen such stability in markets. And a lot of people point directly at the Federal Reserve, that regardless of what happens, the Fed will provide a backstop. And if there is more weakness, this could even provide a bigger Fed backstop, which actually could make some of these stocks rally more. How much do you look past all of the economic data and just bet on this ongoing Fed put no matter what?
It's really, look, I don't think that there is a free lunch in the long run here. But if we take a look at the levels of asset prices generally across the whole world, across every asset class, if we really think about it, would we be here, at 4,400 on the S&P 500, had we not had a narrow shock for the economy with massive macro stimulus for the whole economy, right? This whole terrible, terrible event for humanity has generated a lot of asset price inflation. And again, that is not, a horrible story for where we will be in the longer run. But the longer we persist with monetary policy being easy deeper into the recovery, the ability certainly creates some sort of risks if this persists. And this is one of the reasons why yields, if we're thinking about normalizing later in an economic recovery, then it's one of the reasons why we're not getting long-term yield pressure quite as high as it otherwise.
Steve, do you think that some of these issues that are brewing could overwhelm the cycle? Is that your take, your fear at the moment?
Hopefully it's marginal, right? The Delta variant went out very, very fast in India. It is fortunately, apparently leaving the picture in the United Kingdom, but it is rising in the United States. And so the Federal Reserve would have been here probably looking to start the process, a long-winded process of normalizing monetary policy at the middle of this year. But this fact alone, the fact that there is this dangerous variant, which is having negative effects across the economy, is a reason for them to hold off. If this is a short period in which we're just delaying the whole process of normalization, it probably doesn't matter that very much for the long run. But we can't say that for certain.
Stephen, let's get out in front of your research note for Monday. You're not on speaking terms with Tobias Lefkovich. He's got a cautious view on the equity markets. You've got a bond call towards higher yields. John, what is it, 2%? 1.8%?
City looking for a move back to 2.
Yeah. Stephen Whiting, dovetail your economic view into the damage that Lefkovich and the other guys done.
So look, we think again that yields can rise some. But I think the range, for the reasons I just said, these uncertainties right now probably limit the extent of us reaching what we thought of before. Probably that during the middle cycle period going forward, 10-year yields could be 2.5%, that we could reach 2 by year end. It probably puts that off some. And actually, if the Federal Reserve is tightening later in the cycle, it makes it harder to actually reach those targets. On equities, generally speaking, again, we feel pretty good about the U.S. market. The fact that growth stocks here face very, very little competition from the bond market, period, right? That there are these drags on aggregate economic growth in a few sectors. But broadly speaking here, equities look good and relative to bonds. That continues to be the story. And we have our largest overweights, not in cyclicals, but in healthcare shares, for example.
Interesting. Steve, got to leave it there. Steve Whiting, Citi. Steve, they look good at all-time highs. They always do. On the S&P 500, it's good to catch up, sir. We advanced by just 0.75 of a point this morning. We're dead flat, unchanged on the S&P 500. Got to talk about the Federal Reserve and just some political influence in the mix in the last 24 hours.
I'll say.
Senator Manchin to Chairman Powell, releasing the letter that he sent to Chairman Powell and saying the following, quote, I am deeply concerned that the continuing stimulus put forth by the Fed and proposal for additional fiscal stimulus will lead to our economy overheating and to unavoidable inflation taxes that hard-working Americans, Tom, cannot afford.
Yeah, Vallier shifts from a shoe-in to, well, maybe not. But what's more important here, John, is CBO came out, I believe it was yesterday, and agreeing with Mr. Manchin, the infrastructure bill will do $250 billion or so, add to the deficit over 10 years. So it's not just Powell doing this. Senator Manchin and the others are doing this.
The economy's running hot. Lisa, too hot, that's a debate.
And it's interesting that Senator Manchin decided to release this now. Why now? They're not having a Fed meeting today, are they? We're getting labor market statistics, but it's really this weekend's infrastructure vote, perhaps, that he's speaking to?
Going into the weekend, it seems. We'll head down to Washington, D.C. and catch up with our Washington correspondent, Anne-Marie Horden, very shortly. Coming up in the next hour, Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, ahead of your payrolls report in just a couple of hours' time. Equity futures unchanged. Your bond market yields are higher. Treasuries are softer. 125.33. Yields up 3 basis points. From New York City this morning, it's a beautiful morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. Senate is set tomorrow to approve that $550 billion infrastructure package. It would be the largest infusion of cash in decades for roads, bridges, and other domestic projects. The bill still faces challenges in the House. Speaker Nancy Pelosi has said she will hold on to the bill until the Senate also acts on President Biden's larger spending plan. The U.S. probably enjoyed a hiring spree in July. According to economists surveyed by Bloomberg, today's jobs report is likely to show the U.S. added just about 858,000 jobs last month. The rollout of vaccines has encouraged businesses to reopen and consumers to return to shops, restaurants, and bars. More than 30 U.S. trade groups have called on the Biden administration to resume negotiations with China and remove those tariffs. They say those levies are hurting the American economy. The trade groups include influential organizations such as the U.S. Chamber of Commerce. And in the UK, starting salaries surged at the fastest pace in at least 24 years. Pay for new hires reflects increasing competition for staff to fill jobs that opened with the loosening of pandemic restrictions. British companies from retailers to construction firms are struggling to fill gaps in their workforce. And China reportedly will fine food delivery giant Meituan $1 billion for abusing its market position. According to the Wall Street Journal, Meituan will require to revamp its operations and end its exclusive arrangement with merchants. It's the latest in a series of crackdowns, of course, on China's tech industry. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We're near the top end of the range. We think we get 1.15 million jobs.
We're still looking for 700,000.
I'm in the 750 area.
Part of that has to do with seasonal adjustment.
That feels like a pretty good estimate. In fact, if anything, there's a really favorable seasonal factor.
I just think the seasonal factors are probably a little bit screwed up given the volatility last year.
This is such a difficult one to call. That was Citi's Andrew Hollenhorst, Mizuho's Steve Rasciuto, and RBC's Tom Porcelli weighing in on what they're looking for, the guesstimate, so to speak, in a couple of hours' time. Your payrolls report coming at 8:30 Eastern. Going into that, here's the price action. All-time highs on the S&P 500 into Friday. Equity futures this morning, basically unchanged, up 2 on the S&P. We advanced by 0.05%. Your 10-year yield has been all over the place through this week. 112.58 at the lows. Here we are near the highs, Tom. 125.83. Yields are higher by 3 basis points.
Is this any different than May 7th, John?
You think this smells like May, the April jobs report?
I don't have an opinion, but why is it different than May 7th?
The price of the story is different. 125.83 on 10s. Where were we
158,
back then, Tom?
I believe.
I think that speaks volumes, doesn't it?
I think it does. It's a low-yield regime, and it's a changing world with what we see in the pandemic. On the pandemic, of course, Washington focused, but really focused on this infrastructure bill. Newsom CBO overnight on $250 billion expense, maybe net clean for 10 years. Anne-Marie Horton joins. Anne-Marie, last night I was looking through the 2,000 pages, and I noticed on page 649 there's a very important paragraph on culverts and weirs. You have to be from England to know that a weir is a low-lying dam that is very important. Does anybody know what's in this bill besides culverts and weirs?
Tom, yes, everyone does know what's in the bill, especially those that worked on it. Maybe not to the extent that you do, quoting what is on page 649. But it's bipartisan infrastructure. It's the hard infrastructure we've been talking about in this country for weeks in terms of this deal, but for years in terms of other administrations trying to get through. It's your bridges, your broadband, your highways, all of these things that they want to get fixed.
In honor of the wonderful Richard Trumka, his tragic death last night, let me ask the question that Mr. Trumka would ask. Is this going to create jobs?
That's what the lawmakers say. This will create jobs because you are putting money, investing directly into the economy. And one thing you mentioned there, Tom, about the CBO, saying that the fact that this is going to add $256 billion to the deficit, the question is potentially some of those deficit hawks, those Republicans that don't want any increase to the deficit, potentially we not get those votes through. But what the CBO does not calculate, what many bipartisan senators that worked on this bipartisan agreement say, is the long-term macroeconomic effect of this. Things like adding to the jobs, the boost to the economy that this could bring, that they are not focused on.
One key voice in this, Anne-Marie, what is Senator Manchin up to writing to the Federal Reserve chair?
I was surprised by the timing of this letter to Fed Chair Jerome Powell from Senator Joe Manchin of West Virginia. Remember, he's a moderate Democrat. And what's so interesting about this is he notes two things. One, what the Fed is doing, saying they need to pull back on their monetary policy, but also the fiscal stimulus part of this. Now, as we go through the bipartisan deal, which is expected to pass, then we're going to have the Democrats go through their budget resolution. And then September's the big showdown for the Democrats when they come back from recess to discuss the budget reconciliation. I think this is his warning shot to his party, saying $3.5 trillion is too big. The other thing, potentially, is this a nod, as we have been talking about for weeks, about what is going to happen with Fed Chair Jerome Powell's seat when his tenure comes up? Is this potentially Senator Manchin saying we need to keep a hawkish Fed? There's two big questions about why this letter came out and why now.
Does Senator Manchin have company when it comes to Democratic voices urging the Federal Reserve to take a more hawkish tone?
He has company when it comes to, Lisa, that fiscal spending is just too much and inflation is running too hot. He definitely has company in the Republican aisle, but I would say in his own party, he has a few moderate, those fiscally conservative Democrats who do worry about inflation and do worry that $3.5 trillion on a reconciliation package is just far too much. Notably, I would point you to the Arizona Democrat Kyrsten Sinema. They've really been in lockstep in terms of where they think their party's going and the direction of the economy.
Can you give us a sense, Anne-Marie, of the process? This weekend, you're going to have this vote on the infrastructure bill, but it doesn't really matter because House Speaker Nancy Pelosi said she wouldn't even bring it to a vote if there wasn't another bill having to do with $3.5 trillion Reconciliation Act that people are discussing. So how are they going to maneuver this to try to actually make it a reality?
Well, first for the bipartisan infrastructure, it's procedural quagmire, as Kathleen Hunter in London had said to me this morning when we had a quick chat, or as Punchbowl's calling it, Senate's going to Senate. So there's a procedural vote, and then they get 30 hours of debate. We could see some amendments be added. So likely the end of this weekend, the beginning of next week, that will go through. But then you bring up a good point, and this is what the red line, Speaker Pelosi has said in this, saying that she will not bring the bipartisan infrastructure agreement to her chamber until there is reconciliation. Now, what happens next in the Senate is that Senator Schumer wants to bring forward the framework of that reconciliation. So not the full budget reconciliation. These senators want to get out of Washington for their recess, but the resolution in terms of what that could look like. So September is going to be huge in terms of how this two-prong approach, this two-track of bipartisan hard infrastructure and soft infrastructure is going to go forward.
We keep hearing about September on every single issue at the moment. Anne-Marie, thank you. Anne-Marie Hordern, Bloomberg Washington correspondent down in Washington, D.C. If you're just tuning in, Senator Manchin writing to Chairman Powell, releasing that letter yesterday evening and saying the following: Lisa, I am deeply concerned that the continuing stimulus put forth by the Fed and the proposal for additional fiscal stimulus will lead to our economy overheating. The chairman receiving a letter from the senator on unwinding QE.
And just to give a sense of the timing, the Fed is not meeting today. The Fed just had their meeting. So in other words, in terms of timing, perhaps it signals more to the infrastructure discussions and vote over the weekend than it does to the Federal Reserve. Or perhaps it gives some sort of color to the jobs report that we're going to get in about 2 hours' time.
Well, speaking of timing, Tom, there's another jobs report on September 3rd. There's a Fed meeting on September 22nd. We've got some things to get through here. Next Wednesday is the inflation report. You'll get another inflation report in the middle of September as well. That's going to help set the stage for that Fed meeting at the back end of September.
And again, this is really, really important, John. This is the data dependency and not a 3-month moving average. Each of these reports is discrete, but I have to believe that everyone involved in this process, particularly public officials, is doing just that. They're going to say, wait to see first week of September.
We're distracted by payrolls. Tom, do you want to do the story of the morning? The real story?
Yeah, we would.
We've
lost we had the feed to Barcelona moments ago, but John, you can give us a brief.
One of the most read stories on the Bloomberg terminal today.
Of course, yeah.
Messi's departure is a mess everyone could see coming from the New York Times. Little Messi, arguably one of, if not the greatest football player to ever play the game, Tom. 672 goals in 778 appearances for Barcelona. Juan Laporta, the president of Barcelona, admitting they've got to let him go as this contract ends, Tom, and saying the following. Here's a stat for you. Is this how you run a business? The wages bill currently represents 95% of our income. That's the Barcelona president in a news conference this morning.
Sounds like my tuition bill. Can this guy keep it going at 34 years old?
I think he's got a few more good years left in him, Tom.
Does he say Tottenham?
Barcelona can't afford him, and I don't think Spurs can either.
Damn.
This is Paris or Manchester.
John, you're killing me this morning.
I'm sorry, Tom.
You're just killing me.
In the next hour, Ellen Zentner putting things straight in this jobs market.
She's always one.
Going into the payrolls report, we'll catch up with the Morgan Stanley chief U.S. economist from New York City this morning. Good morning on this Payrolls Friday. This is Bloomberg. Live from New York City for our audience worldwide this Friday morning. Good morning. Let's get you set up for the market day. Payrolls Friday, looking for something in and around 850K. Story right now in the equity market, record highs in Europe. On the S&P 500 coming into Friday. On the NASDAQ coming into Friday right now. Futures positive 0.05%. On the NASDAQ, just a little bit softer. We're down about 0.14%. That's the equity market. Switch up the board and get to the bond market. 2s, 10s, 30s, your 10-year. 125.50 this Friday morning. 112.58 for a brief moment on Wednesday. That's a big range. And we're looking for a big range in terms of the estimates on payrolls too. 350K at the low end, north of 1 million at the top end. What would the central bank do? That's how you work all of this out. You take the data point, you plug it into the market, and whilst you're doing that, you're thinking about how will the Federal Reserve respond to these numbers, if at all. Switch up the board and finish on this, the Aussie dollar. Let me tell you a line that keeps coming from Governor Lowe over at the RBA in Australia. They're not thinking about raising interest rates through 24, into 24, 2024.
Well, that's on the edge of Joe Livornia.
Tom, that's the conversation down in Australia. down under.
Yeah.
The Aussie dollar right now, 73.92, 0.7392. We're a bit softer, weaker there on the Aussie, Tom, by about 0.2%.
Really important observation here to go out. Are we starting to look at 23, 24 as David Costin and the equity markets looks to the end of 22? John, I think over the weekend with this jobs report, you begin to get a gloss on 2023.
You think we can go out to 23 with a single jobs
You're
report?
going to start to see research
you know,
reports.
My favourite line, Tom.
Go there.
It's the most important payrolls report since the last one and until the next one. And we've still got to get to early September before you get to that September 22nd meeting over on the FOMC.
If you do aerospace at university, guess what? You think about dynamics. Our Carl Riccadonna, our Bloomberg Intelligence chief industry economist, is truly expert at the rate of change, the second, the third, even the fourth derivative. And he's looking now at the dynamics of this American economy in a single mathematical phrase is we are lurching lower. He joins us now. Carl, how are we lurching lower?
Well, I think we're seeing a point where we've passed peak growth in the economy, and so we need to consider the the dynamics around inflation and wage pressures and whatnot as we're looking at an economy that maybe this year will grow 7%, but next year will grow about half that much. And as we start to get into the year when we're talking about, or when some Fed hawks are talking about raising rates, we're looking at an economy maybe growing 2%. So will there be a strong case to be raising rates when the economy is growing at a 2% type of pace?
What's the lurching lower now on claims on the people that are out on unemployment? The conservatives make a huge deal of this.
Absolutely. So, folks who have been looking at initial claims over the last several months have, had some real problems with their forecasting models for job creation because it's not layoffs we're looking at now, although there is an undercurrent of layoffs in the economy. What's really a driving factor is the shortage of workers and those workers in low-wage jobs where they can basically get just as much money or close to the same amount of money by staying home and collecting those unemployment checks. We've seen an increasing number of states now ending the expanded jobless benefits, which is then going to presumably force at least some individuals back into the labor force. And so if we look at the collection of continuing claims, plus the pandemic assistant claims and the emergency claims that were added on during the course of the crisis, those have finally started to lurch lower, which means enough states have joined on to the bandwagon of eliminating the expanded claims that there really is going to be a meaningful drift. We're talking about a 2 million person decline between the months of June and July. That's almost double the pace of the prior month. So finally, everyone's saying wait till September. I don't think we need to wait till September. We're starting to see some strong downdrafts already.
That theory gets a real stress test in this jobs report and will do again in September regardless. Carl, what if, and this is a what if question, I want to understand how the Federal Reserve responds to the following conditions. What if the supply side constraints persist through this year into 22? How do they respond to that?
Well, I think we're starting to see evidence that that's the case. That we can look no further than last week's GDP numbers, where we saw huge inventory drawdowns in the second quarter. That's not going to be alleviated in the next quarter or two. So it's kind of squeezing the tube of toothpaste, if you will, and we're squeezing the lump of some of that hot growth into the back half of this year, and certainly some of it can spill into next year. At the same time that anecdotes around microchip shortages and whatnot are starting to look on a longer time horizon for resolution. So I think very much that's a realistic scenario, first of all, John. And secondly, the Fed has told us, as long as it's Jay Powell's Fed, which I presume that will be the case when he's renominated next year, the Fed is going to continue to look beyond those supply shock disruptions as they're thinking about price pressures in the economy. And that is the correct approach that they should be taking. So if it stretches longer, then transitory becomes a little hotter and a little longer than they initially anticipated. But it's demand side inflation pressures that really will motivate the Fed to say things are getting too hot. We need to cool things down.
Carl, just to underscore John's point, though, what can the Fed do if this is a supply side constraint? What does easy money policy really help with that particular issue?
Well, in a longer run, it doesn't fix it in a quarter or two, but in the longer run, by holding interest rates lower, that reduces the cost of capital and enables businesses to go out there and make the types of adjustments investments to expand capacity, invest in equipment and software, and then address the higher level of demand. So they build the infrastructure to basically address that supply shock.
Stephen Ricciuto of Mizuho is on yesterday, and he was saying that he doesn't think the Fed's balance sheet will ever shrink. In fact, it will probably continue to grow in line with the GDP. Do you think that that is a realistic assessment, that we have moved to a scenario where we need a central bank balance sheet that is of commensurate size with the GDP as they basically monetize the increasing debt?
Well, the Fed has held its cards pretty close to its vest on this issue, and I've been pushing this issue to try to get answers. What happens when tapering is done? Do we actually start to decrease the size of the balance sheet, potentially in concert with interest rate increases, or do we simply just wait and grow into the balance sheet, which is pretty much what happened after the last crisis? There was a little bit of shrinkage. And I think Fed policymakers and central bankers in general are increasingly coming to the view that in a low interest rate regime where the Fed is often going to be constrained by the zero lower bound and not entertaining the prospect of negative interest rates, and rightly so, I would add, that they're going to have to lean on the balance sheet more. So even if they would like to shrink it, just the dynamics and the natural occurrence of recessions in the economy is going to prevent them from shrinking it too much. So I don't know that it has to grow along with GDP, but you are going to see the Fed balance sheet continuing to expand even once we've gotten past the tapering and the reductions where we currently stand.
Hey, Carl, just want to jump in with some news from Singapore. Singapore to resume entry permits of vaccinated foreign workers. Singapore to allow dine-in, lift gatherings to 5 from August 10th. So, Tom, we've got a little bit of tightening this week over in China. In Singapore, a little bit of loosening, and each country, every region dealing with this in a different way.
Why is the United States any different? I really looked at the numbers this morning, John, into the weekend of hospitalizations in America, whether it's Singapore, Indonesia to the south, whether it's Mississippi, Florida, or what's up north. It's every state for themselves.
Headlines on Wall Street yesterday, BlackRock and Wells Fargo pushing back the return to office by about
Amazon,
a month.
too.
Carl, we've seen this across the board now increasingly by some big American companies. What does that mean for your calculations for this recovery?
Well, what that means is that we can consider a very light version of the kind of lockdown returning. You mentioned Amazon and some other large companies. I also saw a headline yesterday, Garth Brooks contemplating whether or not he'll have his tour dates in September. So we could be looking at a phenomenon of a Garth Brooks effect in the economy in the back half of this year, where people are afraid to go fully reopen the economy. So they may be going back to work and maybe kids are in school, but whether they're taking a cruise or going to an amusement park or sitting indoors in a restaurant or a crowded theater, those will continue to be depressed. And if we look at some of those mobility metrics and things like open table reservations and whatnot, we do see things are starting to roll over. So some of that Garth Brooks effect is actually starting to arrive in the economic data already.
A draft piece of research written somewhere with that headline, Carl.
I don't see it happening in today's jobs report, but I think this could be a phenomenon we have to address in August, September, and beyond, and it could continue to weigh on that labor force participation issue.
Carl, this is cruel. I just threw out all my big vertical striped shirts. I just threw out all my Garth Brooks shirts. And you say he's back in the fold here.
Carl Run.
Remember, Tom, he sings two kinds of music, country and Western.
Carl Riccadonna,
all right,
of Bloomberg Intelligence, our chief industry economist. Let's get real and go back to that Goldman note from a couple of weeks ago. Remember that week we were all talking about Goldman downgrading the outlook for the U.S. economy and why? The core of that piece was about delaying a full service sector recovery. And Tom, the delay of BlackRock and Wells Fargo is just a couple of companies. There are others. It speaks to that theme, Tom.
It does. I mean, it's there and it's going to be in the data. And John, what's so important here, as Carl started his conversation on, as we go from what we all observed, a boom economy, and then there's a middle road. And as Jan Hatzius has said, you score down to 3%, under 3%. As Michael Ferroli at JP Morgan says, why not under 2%? That's unimaginable now with 7 million delta on unemployed.
Lisa, it's so difficult to make a call on this economy at the moment.
Which I wonder how much people are going to take a look at this jobs figure and say it's backward looking. We have to look forward. And frankly, the high frequency data does point downward, whether you're looking at airline tickets or frankly, Michelle Meyer over at Bank of America Securities, chief economist there. coming out and saying
I
that
saw
actually credit card and debit spending was materially down in the past week. And of course, we don't know how much this has to do with Delta variants, but we have seen travel fall off. I mean, it's a moving target. This is a very quickly moving economic recovery.
This is your target this morning, 858,000, the median estimate in our job survey going into payrolls. Your payrolls report just a couple of hours away. Here's the price action, all-time highs into Friday on the equity market. Futures this morning up 2 on the S&P 500. We advanced by 0.04%. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. The Senate is heading toward a weekend vote on its $550 billion infrastructure legislation. Senators huddled on and off the floor to discuss final changes to the bill, which is 2,700 pages long. Even if the bill is passed, it faces an uncertain future in the House. There are growing signs that coronavirus Delta variant risks slowing the pace of the U.S. economic recovery. Some events like the New York Auto Show are being cancelled due to virus concerns. Meanwhile, Bank of America says that a pullback in credit card usage could partly be due to the surge in cases. And Iraq has gone back to the IMF for a loan of up to $1 billion. Talks began last year as oil prices were tumbling, but eventually were halted. Iraq's government is looking preemptively ahead for help to cover its budget deficit. Nintendo fell after its quarterly profit missed estimates. That underscored concern that gaming demand may be peaking as parts of the world emerge from the pandemic and go back to work. Meanwhile, Switch hardware sales fell by 22%. And Ford is looking to eliminate about 1,000 salaried positions in the U.S. The automaker is offering a voluntary buyout program. Ford is trying to realign operations while it's transitioning to electric vehicles. The company has about 182,000 workers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
The big issue is if we mandate it for drivers, I think we'd have to mandate it for riders as well. I don't think that to have a company have the power to mandate vaccinations over 100 million people who are moving around is probably the right call. So we are going to work with governments based on government mandates, local mandates. We're going to follow them.
Dara Khosrowshahi there, the Uber CEO, and anyone that's tried to order an Uber recently knows that that company needs drivers. They need drivers. Tom Keene, Lisa Abramowicz, Jonathan Ferro. This is Bloomberg Surveillance on his Payrolls Friday. Here's the price action. On the S&P 500 up 2, advancing 0.04% into the bond market. We had a huge bid on Wednesday for about 5 minutes. 125.66. Yields are higher now by 3 basis points. We had a little look at 112 earlier in the week. In the FX market, euro dollar 118.10. Negative there, Tom, 0.2%. That is a weaker euro.
Yeah, I still frame the markets, John, from where we were 2 weeks or 2 months ago, which is we've really seen a dampening here on everything but equities to the moon. Right now, we're going to shift here on this jobs day, as you just heard from the gentleman from Uber, on this pandemic. Andy Peckhus has helped us out so much with Johns Hopkins Bloomberg School of Public Health. He is a virologist. Andy, I want to go to the leadership necessary, as we just heard from the CEO. And I guess I can take it to you, where we've got the horrific issue that the father supports Arsenal and the offspring support Chelsea and Manchester United. This is a twisted household. Should those sports teams lead? Do you see, like, for example, in Italy, AC Milan just says you got to be vaccinated to their players?
You know, there are lots of paths forward right now. I think this is the positive thing these days. I know we worry about Delta. I worry about Delta a lot. It's a virus that's doing things that are differently, but there are paths forward. It may require a little bit of individualization in terms of what happens. It may be that different companies want to put different things into place, combinations of staggered work weeks, vaccination mandates, saliva testing has turned out to be a quite efficient way of tracking initial cases of virus. So there are ways that we can get our economy back and going.
Right.
We just have to be very creative in terms of how you do that and think about how they apply to your particular situation.
Did we have this argument with typhoid?
No, but things were that's a very different disease, very different way of dealing with the infections because of the source of the infection and how it's spread. So respiratory viruses are by their nature a very, very different disease to control because of the way it's spread, because of the contact that's needed to spread those viruses. And so we have to think more creatively about this. I think we also have to realize that this country right now has many different snapshots of infections. Maryland is nothing like what's going on in Louisiana, or nothing like what's going on in Florida. So we always have to match our public health interventions to what the gravity of the situation is locally.
Should vaccinated individuals, Andy, still be tested for COVID? And I ask with respect to people going back to the office, albeit perhaps a little bit later than they previously had expected.
Yeah, right now, I don't think that's needed. If you're vaccinated, again, your risk of infection is very low. I know we're talking about breakthrough infections with Delta, but they still represent a minority in the vaccinated populations. So a strategy where vaccinated people come back to work with proof of vaccination, of course. Unvaccinated people have limited access, have to go through testing to make sure that they're not coming in positive. Those are things that can work really well, particularly if you know that your workplace is vaccinated to a high degree, 75%, 80%, something like that.
Do you think that the messaging has been wrong, Andy, when it comes to the Delta variant and vaccinated individuals? Because we see everyone wearing masks, some recommendations to even wear masks in your own home if you have unvaccinated children, even if you've been vaccinated. Do you think that this all sends the wrong message about the efficacy of the vaccinations?
You know, I think communication could be better around this issue. The bottom line is the vaccines are still working against Delta variant. We are seeing some breakthrough infections, more so than we saw previously, but there are a lot of factors that can come into that. And when you've got community spread that's rampant, you don't want to rely on one thing like vaccination to protect you. You need those multiple levels. And that's really where masking comes into place. It's an additional tool for a specific situation, large-scale spread of the virus in unvaccinated individuals. And I think we're backing away from that message. It's getting muddled into vaccines aren't working, so we need to do more even if you're vaccinated. That's not really the message. So we have to be better at communicating the true use of these things and why we're doing these in this particular time.
And Andy, communicating to who? Something really sad is developing in this country, and more people have started to write about it in the last couple of weeks. I believe you and I have talked about it before. This came from the Washington Post in the last 24 hours, and it was on vaccinating teens in D.C. And the following stat is just horrendous. 51% of white 12 to 15-year-olds have received at least one dose, while just 14% of black youths in the same age group have received one. That's according to city data. Andy, what is going on here?
Again, the communication methods that we thought were able to reach large swaths of the population turn out to not to be the most effective ways of getting to the smaller groups that are now the ones that are suffering the most from disease and have the lowest vaccination rates. We have to rethink communication. We have to think about where the populations are that are under-vaccinated and how to message to those effectively. Some of the things that we think are good in terms of the broad-scale approaches just aren't reaching those populations. And I know personally from talking to people one-on-one that there are a lot of people out there that are just looking for that information. They just haven't gotten it in a way that makes them feel comfortable about it. And that's where we really have to rethink everything about the communication around these vaccines.
Andy, thank you. Thank you, sir. Thank you very much. Andy Peckosh there, Johns Hopkins Bloomberg School of Public Health professor and virologist. And Lisa, quite clearly, there's some real work to do here.
Well, there was actually a recent Kaiser survey. I'm trying to pull it up, but it basically showed that a majority of unvaccinated individuals thought that the vaccine could potentially harm you more than the virus. Just to talk about failed communication. That has not been proven to be the case. The science shows that it is incredibly effective and incredibly safe for the most part. But the fact that that is the perception, John, gives you a sense of the messaging and the work that has to happen.
That mistrust of government, Tom, is far more pervasive, I think, through society than some people are prepared to acknowledge.
Yeah, it's there. And of course, social media has enhanced all this, Facebook and the rest of it. My challenge with this, John, is I looked this morning at CDC, which is incredibly accurate on per capita hospitalizations. Florida is an unmitigated disaster. There's no other way to put it. I don't know how you communicate that other than mandates.
It is just very sad at the moment, Tom.
It is a moonshot of hospitalizations.
Elisa Abramowicz, Jonathan Ferro on this Payrolls Friday. Let's rattle through the price action for you and prepare you for that payrolls report in about 1 hour.
Look at the VIX.
35 minutes. Equity futures up a single point on the S&P. We're basically unchanged. Into the bond market, we have been all over the place. On a 10-year yield, we're up 3 basis points on a session to 125.50. In the FX market, euro showing a little bit of weakness, dollar showing a little bit of strength. Euro dollar 118.07. We're negative there, 0.23%. And crude climbing, crawling back to 69.97 on WTI, advancing by 1.26%. From New York City this morning, good morning on this Payrolls Friday. This is Bloomberg.
We've been waiting for vaccines. We've been waiting for the supply to pick up, and supply is exploding.
We're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained?
We've taken wealth from the public sector and we've given it to the private sector.
The Fed believes they have flexibility.
In this world of great uncertainty, if you're pushed by what happens in 1 or 2 meters, you really haven't got the plot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Payrolls Report, 90 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 2 on the S&P, basically unchanged, Tom. Just going into the jobs report a couple of hours away.
Equities grinding over the last 3 days to a better VIX, 17.14. That's a new low, John. It's an improved bull market VIX. But you look everywhere else, John, and there's just that domestic and global angst as we go into this payroll report.
And yet, Tom, what do we see? Record highs over in Europe in the equity market. Record highs on the NASDAQ. Yep. All-time highs on the S&P 500. We talked about it yesterday through the week.
Right.
We keep climbing that wall of worry.
Liz Ann Saunders with industry leadership at Charles Schwab out on Twitter with smart charts. And it's real simple, John. The premia, you take the yield and you flip it, and that gives you the PE. David Kostin's out at 22 times earnings, partly because of this low yield and a permanent low yield regime.
David Kostin looking for 4,700 on the S&P this year, 4,900 next year. Lisa, the estimate this morning, 858,000.
Yeah, basically the jobs market is going to recover. The worry, however, is pervading the markets. Interesting to hear economists say that actually the worry is positive, that when we get a hot labor market, the fact that there are these dampening factors may keep this economic recovery going longer, not only because it keeps rates low, but because it keeps it from overheating, John.
Who do you think of if we get an upside surprise, Governor Waller or Governor Brainerd?
Governor Waller.
You think of Governor Waller, Tom? Do you think Governor Waller is really pushing this one forward into September?
I think he'll get derailed by the centrists at the Fed and by the politics of the moment. And the politics is about the primary elections of 2000, primaries into 2022. As you saw with Manchin and Powell today, it's all a political soup.
So much to get through before we get to September 22nd and that Fed meeting. Let's start with some price action for you this Friday morning. Good morning. Your equity market on the S&P 500, positive 2, up 0.05% on the S&P 500. As I said, I'll repeat, we come into Friday at a record high. Into the bond market, 125.66 on 10s. Yields are higher by 3 basis points. The euro's weaker, the dollar's stronger. Lisa, euro dollar 118.05, negative 0.25%.
And we've watched that 10-year yield rise from what you said, touching 1.12% earlier in the week. Now we're talking about that 1.26% yield almost. And really, I do wonder how much this jobs report is going to inform that, especially after Fed Vice Chair Rich Clarida came out and said really it would just take a couple of meetings, a couple of reads to really get a sense of the fact that they could taper sooner. 8:30 a.m. We've been talking about it, this payrolls report. We have not been talking about income and salaries and how much we might actually start to see wages rise on a wholesale level. We've talked about the labor force participation, but wages will remain in the forefront as an indicator for future inflation. Then at 10 a.m. or in the 10 a.m. hour, President Joe Biden is planning to speak about this labor market report. How much does he dovetail it into the weekend? The vote on the infrastructure bill, the potential for additional stimulus coming from the reconciliation activity from the Democrats. Does he indicate some sort of cohesiveness in his party that has been increasingly bifurcated among the progressives and the centrists? And then at 1 p.m., we get the real yield. We also get the Baker Hughes rate count.
Thank you, Lisa.
Anytime. Both are important. I really think that the real yield will be, I'm sure, very important, especially today since we have such deep negative real yields. But with the Baker Hughes U.S. oil and gas rigs, they have maintained discipline. They have not come back online despite the increase that we've seen in oil prices. How much does that change?
Yeah.
I mean, at what point do we get people saying, let's pump?
John, I think an important conversation here is the one you're going to have with Martin Walsh, the Secretary of Labor. We're going to see that. When do we see that, John? The 9 o'clock hour?
Around about 9:45. That's the schedule, Tom. That's the time of the diary.
This is about job formation. And Chairman Powell has made it clear that's part of their mandate. We're nowhere near getting back to where we were February of 20.
Tom, I'm with you, and back to school is a huge piece of this.
Yes.
Lisa, you've talked about this repeatedly over the last few months. September. It's a big month.
Well, and I wonder if perhaps some of the back to work kinds or the back to office plans being derailed, how much has to do with questions around back to school, because parents are not going to want to go back to the office if they aren't sure where their kids are going to be.
Subhadra Rajappa joins us now from Societe Generale, US Rates Strategy Head. Subhadra, good to catch up. Let's start with payrolls. 858 is the median estimate. The range is huge. It always is these days. 1.2 million to 350K. A lot of people in this bond market wondering, what moves the dial more? Big upside surprise or big downside surprise? Which one, Subhadra?
I think the bar is quite high for this report, right? You really need to see either at or above consensus number for today and for the bond market and yields to continue to rise from here on. Thus far, what we've seen is sort of more, rally on bad news and gloom and doom getting priced into the bond market. For that gloom and doom to get unwound, you really need to see a very, very strong number today. And not just the headline number, but across the board. You need to see the participation rate increase. You need to see strong, evidence that people are actually coming back to work. So it really needs to be a strong report overall for a decent sell-off from here on.
Subhadra, where's the wall of money fit into all this? I mean, the quiet thing, we really haven't talked that much about it this week, is the overwhelming price action of your world. Bills, notes, and bonds is a wall of money pushing price up.
It will be next week. We have the refunding auctions next week. 126 billion hits the market. So the market will start to price in some concession going into new 3s, 10s, and 30s. But broadly speaking, I think the supply picture is actually quite, positive in the sense that at the November refunding meeting, the Treasury is going to reduce its auction sizes. So that should be somewhat supportive to yields. But broadly speaking, I think there's still a lot more bond issuance over the remainder of the year. And as the Fed starts to pull away from the bond market, I think the pressure is towards modestly higher yields from here on.
I'm in thundering silence here, John, about the uncertainties going into this jobs report. John, do we have plus or minus 3 basis points? Any clue where yield is?
Well, Subhadra, let me put it this way. Tom keeps bringing this up. How do we respond to a May repeat? The April jobs report, which was just a monster downside surprise. How would we respond to that?
I think we'd see a significant rally in the bond market because there's a lot riding on this report. You need to see, at least 2 strong jobs reports before the Fed gets comfortable about announcing tapering of asset purchases. And this jobs report is going to be very, very important because that sets the stage for the September FOMC meeting and subsequent policy action from here on. So I think if you get a miss, we get a 250,000 in the headline payrolls. I think that's going to, reverse some of the sell-off we've seen in the last 24 hours.
Subhadra, how much does it matter that the expectation is for the U.S. Treasury Department to actually sell less debt going forward? They've actually reduced their funding requirements at the same time that the Fed has not yet announced a tapering to their bond purchases. In other words, if they keep it the same, it's basically an acceleration of stimulus in an effective manner.
Yeah, it is. But I think that the Treasury is clearly overfunded. There's a lot of uncertainty, as you mentioned earlier, about the infrastructure plan, as well as the human capital plan and what size that's going to be. That could easily add another perhaps $3 trillion or so in spending. A lot of that could be offset with revenues. But broadly speaking, the Treasury is definitely very overfunded. So they are going to cut coupon issuance sizes at the November meeting. But again, from a fiscal side, we've been very, very accommodative the whole time around. On the monetary policy side as well, policy has been extraordinarily accommodative. Now it's time to sort of pull back both the fiscal as well as the monetary stimulus.
Subhadra, the Fed's balance sheet right now is $8.2 trillion. In a year, how big will it be?
It could be another trillion higher.
Wow.
It really depends on what kind of tapering program they put in place. Our expectation is that our expectation is that they will start announce at the earliest in November. They could go a lot faster after they announce if the data continues to be proves to be somewhat stronger than expected.
John, this is nuts. We have a bond pro here, Ms. Rajappa, telling us we're going to go out to 9 gazillion on the balance sheet. I don't care how you massage this. This jobs report and all around it is completely outside anything.
Well, think about it, Tom.
Before.
This jobs report has got us thinking about the flow of bond buying. And Subhadra, let's finish on the stock. How powerful the stock will be, the portfolio effect, the balance sheet effect over at the Fed for years to come.
I think that's a very, very important factor because the Fed holdings are quite large. There's no indication that they're going to be pulling back on, or I should say reducing their balance sheet anytime soon. The balance sheet's probably going to remain in the context or slightly above where we are right now for the next couple of years. They're thinking of hiking rates in early 2023. So beyond that, the balance sheet's going to remain strong, which means that the Fed is going to continue to purchase assets on an ongoing basis as add-ons at the auction. So they're going to have their tentacles in the bond market for a very, very long time. So I don't really see them, paring back their balance sheet anytime soon.
Subhadra, it's good to catch up. Thank you.
That was wonderful.
Subhadra Rajappa,
really good.
SocGen US rate strategy
John
head.
dazzled all stock and flow. Explain,
Tom,
John.
that's the issue, right?
It's like a bathtub. John, explain the bathtub model.
Look, this balance sheet will be reinvested over time, Tom, until they try and unwind it. And that's going to take a long, long time. And what we saw last time around is when they started to try and unwind it, Lisa, that's when the pain really started to build. That was when the old story of tapering was not tightening. Well, unwinding started to become tightening in a fashion. Anyway, at least that was always the market belief, and that was the problem for Fed communication.
And that's the reason why Steve Rasciuto said that he doesn't think that the Fed's ever going to shrink their balance sheet and will continue to expand it in order to keep the status quo. What is the broader implication of this, John? Is it that this is their main reaction function at a time when they're not going to get that far away from 0% interest rates?
For balance sheet watchers at the Federal Reserve, you can book a seat on the Lisa Abramowicz tour at 4:30 Eastern on Thursday afternoons.
Exciting.
Lisa Abramowicz, Tom Keene, Jonathan Ferro. I wasn't joking, that's what Lisa does on a Thursday afternoon at 4:30.
Everyone knows that.
How big is the balance sheet now? Equity futures up 3 on the S&P, advancing 0.07%. On its Payrolls Friday, more insight from some wonderful guests, including Bill Dudley, the former New York Fed president, who will be joining us shortly. Your equity market just a bit firmer, near all-time highs. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. Senate is set tomorrow to approve that $550 billion infrastructure package. It would be the largest infusion of cash in decades for roads, bridges, and other domestic projects. The bill still faces challenges in the House. Speaker Nancy Pelosi has said she will hold on to the bill until the Senate also acts on President Biden's largest spending plan. And the U.S. probably enjoyed a hiring spree in July. According to economists surveyed by Bloomberg, today's jobs report is likely to show the U.S. added just about 858,000 jobs last month. The rollout of vaccines has encouraged businesses to reopen and consumers to return to shops, restaurants, and bars. And more than 30 U.S. trade groups have called on the Biden administration to resume negotiations with China and remove tariffs. They say those levies are hurting the American economy. The trade groups include influential organizations such as the U.S. Chamber of Commerce. Public universities in the US face student lawsuits over coronavirus vaccine mandates. According to the Dow Jones, lawsuits challenging the vaccination requirements have been filed in Indiana, Connecticut, California, and Massachusetts. Students claim they have a constitutional right to go to college unvaccinated. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained? I think we're going to see them transitory for a while. I don't think they're necessarily going to be sustained over the year to 2 year horizon.
Great to catch up with Randy Krosner there, the University of Chicago Booth School of Economics professor and former Federal Reserve Board member from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Friday morning, it's Payrolls Friday. 858,000 is the estimate in our survey. Futures going into that +3. We advanced 0.07% on the S&P 500. Bond yields are higher by 3 or 4 basis points. Had a little look at 126 earlier this morning. 125.66 right now. And WTI, Tom, let's round it out with crude, reclaiming a 70 handle at $70.11. We're back up by about 1.5% this morning.
Yeah, it was a good signal of this global slowdown fear. Don't really know what to make of it. I would note Swiss 20-year, which I mentioned, John, has recovered a little. European yields. But to me, John, it's all noise. Don't you agree?
Oh, totally. It's all noise until we get to the payrolls report.
Noise.
And Tom, even if I told you the data right now, would you be able to tell me how the market would respond?
Well, I'd fake it like I do in the media every day. But no, the answer is
and I would join you. But at this point, Tom, I'd have no idea.
Let's go to somebody who has absolute certainty on what's going on in Washington. Emily Wilkins joins us. Emily, almost heaven, West Virginia. Mr. Manchin set off a comment on Chairman Powell, but far more importantly is what the senator from West Virginia is facing at home, which is constituents and inflation. Explain that tone in Washington of all these different fancy people in suits and ties and their constituents saying, look, here's the non-transitory here and now.
So there are two narratives right now at battle in D.C. One of them is that inflation is a huge problem, that the Biden administration needs to get in gear addressing it. And the other narrative is that, yes, inflation isn't looking good right now, but it's just the economy coming back online after COVID. Give it a few months and everything's going to shake out and be fine. Now, obviously, the White House is in favor of that latter narrative, and they're hoping that most Democrats go with them. But we are beginning to see fault lines with, as you mentioned, Senator Joe Manchin writing that letter to the Fed saying, hey, you guys really do need to start addressing inflation going forward. And this could play into that upcoming debate. I mean, we've all been focused on the bipartisan infrastructure bill, as we should. But remember, this is a dual track process. We have that $3.5 trillion reconciliation to consider, and that could be stymied if there are these inflation concerns.
You've drank the Kool-Aid. I get the inside the Beltway thing. How many other Joe Manchins are out there that are saying almost heaven Missouri inflation or almost heaven Idaho inflation? What's the tone that agrees with Joe Manchin?
Well, right now, it's mostly hearing from Republicans who have concerns about inflation. And those Republicans are not going to be voting for this $3.5 trillion reconciliation. We knew that from the start. Question is how many Democrats agree with Joe Manchin. And there's definitely the potential that there could be more, particularly if we continue to see inflation rise the way that it has and maintain this very high level. There are a number of moderate senators, Kirsten Sinema, John Tester, who could potentially join Manchin in saying, hey, we're not really sure about passing this $3.5 trillion spending package.
Well, first we have to get past the $550 billion bipartisan infrastructure bill. There's a vote this weekend. My favorite quote in the story about that on the Bloomberg is from Dianne Feinstein, California Democratic senator, as she left the floor on Thursday night. Everybody's in a bad mood in there. How tense is this? What's going to happen? What's the main point of dissent that people are going to be arguing about this weekend?
Well, look, no one likes having to stay at work late, especially if you're a U.S. senator. The arguments that they have at this point are about a couple amendments. Last night, they were hoping to pass this big package of amendments, finalize the bill, and then get everyone home. But that got held up by a freshman senator from the state of Tennessee, so that did not happen. A couple things left dealing with cryptocurrency. How wide or how narrow should regulations be, as well as whether or not states should be able to use some funding from allocated for COVID-19 to go towards infrastructure. So that would wind up being a bit of a pay for there.
I'm sorry, not to cut you off, but cryptocurrency, how does that fit into infrastructure having to do with rebuilding America? Connect the two, cryptocurrency regulation.
No, it's a great point, and it's a pay for. The idea is that they are trying to still, at this 11th hour, find things and ways to pay for this infrastructure bill. And you heard them go through numerous ideas. You've heard them looking at selling off petroleum and oil reserves, of delaying Trump-era regulation that never went into place in the first place. I mean, I think you heard Bloomberg news reporters kind of say it quite well in one of their stories. They wrote that this is the federal government equivalent of looking for change in couch cushions.
Emily, is there any difference between legislative policy making, sausage making, budget expansion in a Biden government versus a Trump government? The answer is it's going up.
It has. It absolutely has. And to a certain extent, when you talk to Democrats about sort of the amount of federal spending, they're very quick to point to that 2017 tax bill that was passed under a Republican House, Republican Senate, and Republican White House that Democrats say, and it has been shown, has added to the federal debt and the federal deficit. So there's definitely been spending on D.C. on both sides of the aisle here. But when you are the party who's not in power, as the Republicans are right now, you do tend to oppose things that majority is doing, and one of the arguments they are using right now is that spending argument.
Emily, thank you. Good to hear from you. Emily Wilkins, Bloomberg government down in Washington, D.C. Tom, loving the John Denver drop there. Just dropping some lyrics.
Did I do that okay?
Nice. That was beautiful.
Yeah,
You could describe the White House, couldn't you? Life is older. Life is old there, older than the trees. Something like that? No, you don't want to go there?
No, I'm not.
You don't want to play? Don't fancy it?
I'm just not going to launch into John Denver.
I'll get to the price action. Equity futures up 3 on the S&P, up 0.07%. What has stopped you before? Yields are higher by 3 basis points. There we go. Younger than the mountains, growing like a breeze. 125.33 on 10s.
I love that going
Yields
to a
higher
market
by
check.
3 basis points.
That's
Go on,
like,
Lisa.
That's like being put in the corner. It's like, time out.
On this show, that is time out.
That is time out.
That is time out.
Literally.
Look at this
You've done
tweet,
it,
John.
Tom.
Would you translate this tweet,
I'll do
please?
my best if you get the
Please,
tweet
I
up for me to
have no
see. What
clue.
tweet?
On radio, this is this iconic tweet where the guy's looking at the other girl while he's walking with his girl.
That classic
and
meme.
Michael has gone out here and done a Tottenham thing for John and I. John, Harry Kane is with the guy.
The attention's all on Messi. So the media attention has turned to Messi and away from Harry Kane.
Is that what that means?
That's what's happening.
For those of you on radio, it's Greek to me.
And I wonder, Tom, if Manchester City are looking at their plans right now and wondering whether they want to get in here and get Messi to Manchester City and maybe avoid Harry Kane.
Seriously, John, are there other Manchester cities out there to support their TV revenue?
To be honest, Tom, there's only 2 clubs that can really afford the wages here. And one's Paris Saint-Germain and the other's Manchester City. They're the only 2 clubs that I can think of that can get it done. The other outsider may be Chelsea, but apart from that, that's about it.
Really? And the Tots aren't part of that?
No, your Tots are not part of that conversation, unfortunately, Tom.
How about Preston North End?
You've got to try and hang on to Harry Kane. Preston
No,
North
he's
End.
gone. Right,
John Riding's Preston.
Seriously, John.
That is not part of the conversation.
Stop non-farm payrolls.
Stop
Harry Kane is
non-farm
like
payrolls.
not gone?
Not yet, no. Grealish apparently has. Do you want to continue this in a commercial break?
Probably not, actually.
Naughty step. Get on the naughty step. The S&P up 3. We advance 1/10 of 1%. From New York City on radio and TV.
Jobs report in the
This is
break.
Bloomberg. Live from New York City for our audience worldwide on TV and radio. Good morning to you. Here's the price action this Friday morning. Equity futures positive 0.06% on the S&P. Record highs coming into Friday on both the S&P and the Nasdaq. The Nasdaq just a touch softer, lighter, lower by 18 on the Nasdaq 100. We're down by about 0.12%. We switch up the board. It's the fear of a May repeat, the April jobs report. We looked for 1 million, we got 266. We looked for 858 today, and we wonder what a big downside surprise would mean for this market. Tom, you brought this up. I think the price of the story matters, because when we had that jobs report, yields, as you pointed out, your 10-year was 158. Your 10-year right now is 125.33. So what do you believe, Tom? A really hot ISM or a really soft ADP?
I believe we got to get away from the minutia that the media is focused on. I think, frankly, everybody at Bloomberg's doing a real good job of that, of trying, John, to look at the larger picture and link together what's on the Bloomberg terminal. I would suggest equities speak volumes.
Let me tell you what I believe. Switch at the board and finish on this. I believe, like so many people believe, there is a ton of demand in this economy right now.
All jolts. You're just
and we struggle to find the supply. So these are job openings in America, and Tom Keene, they are sky high. And this is the question for August, for September. Going into that September 22nd meeting, Tom, will we have some evidence the supply is starting to meet that rock-solid, robust demand?
Yeah, for those of you on radio, Ferro channeling Michael McKee here with a jolt of the jolts. And, John, this is really important. The number of jobs that are out there is stunning. I mean, it's basically unmeasurable.
It speaks to that fantastic demand we have in America right now, Tom. The big unknown is how quickly supply will heal for the year still to come, for the several months we have left. Will prices get it done? Tom, we can talk about that with Alan Zentner and Morgan Stanley in just a moment. Let's get you some movers. Let's cross over to Bloomberg's Romain Bostic. Hey, Romain.
Hey, good morning, John. We have some breaking news crossing the wire right now. This on United Airlines. United Airlines is going to require all of its workers to be vaccinated. This will take effect in late October, and it coincides with what United is saying is going to be an update to the FDA's guidelines here on the vaccine. Remember, the vaccine approvals out there right now are for emergency use, which raises a lot of questions about people who have medical conditions. It is expected that the FDA will move to make that approval basically a full approval. Basically means it's safe for everyone, and United says that means all of its workers need to have that vaccination. It already says about 90% of its pilots are already vaccinated, and about 80% of its flight attendants. It wants 100% basically by the end of October. There will be some exceptions if documented for medical and religious reasons, but this is the first major airline to do this, and it is expected that the other major airlines will follow. Keep an eye on that space. Also keep an eye on the rest of the travel space as well. We did get earnings out of Expedia yesterday. They were good overall. The problem, of course, is that there's a little bit of a slowdown here, and the buy-side analysts that we talked to seem to want to see a little bit more aggressiveness with regards to guidance. This is the broader story going on right now in the travel space for the airlines, for the hotels. Things are great right now, but the sustainability of this is certainly in question, as well as, of course, all of the concerns about the Delta variant and how both workers as well as customers are going to be protected. Novavax at the top of your screen, those shares down 10%. Interesting story there. Of course, we know they had a very good trial with regards to their COVID vaccine. The problem is they still haven't submitted for approval here in the U.S. The problem is that their manufacturing guidelines don't quite meet FDA standards. They're pushing back their submission for authorization till the fourth quarter. That's at least the second delay that we've seen out of Novavax. Flip up the board, a few other names just to keep an eye on this morning real quickly here. DD shares getting a little bit of a bid here. Some news here that they may be finding a way to comply with the latest regulatory issues there over there in China. FireEye and the cybersecurity stocks down here as well on a slight miss, as is mobile gaming company Zynga.
Romain, thank you so much. Greatly appreciate it. On this Jobs Day, Ellen Zentner joins us from Morgan Stanley. Thrilled that she could be with us today. Ellen, how's your x-axis changed? Our great debate at Surveillance is the idea of a boom economy back to some normal. Tell me about your 21, your 22, your 23, and the American labor economy.
Yeah, so I think it's going to be a slow slog back for labor force participation. I mean, we saw a drop of more than 3 percentage points, which has never happened in history. Labor force participation can decline, but I think 1 percentage point was the historical biggest number, and then it can take years to climb back to pre-downturn levels. And so it's just going to be a slow slog. We're going to get some bumps here and there, and so one of the upside bumps we're expecting is, as John said, around September, August, September, as schools are reopening fully and more people can go back to work. So you'll get some positive bumps there, but I think it's going to take quite some time for normalization in labor force participation rates, and that's, of course, going to dampen how much economic growth you can get. Now, we still have a lot of stimulus in the system.
Right.
and we've still got more legislation to go. And so the economy is slowing sharply next year, but still growing above its potential. But I think, as you said, look out to 2023 and beyond.
Right.
It won't be difficult for the economy to fall back to a one handle if you don't get more participation.
Okay, the one handle is unthinkable. I mean, the basic idea here, and this is almost a global central bank question, Ellen Zentner, the idea that we can stay accommodative longer runs up against a massive pressure to right the ship sooner rather than later. How do you judge that right now with a Powell Federal Reserve? Are they going to be sooner or are they going to be later?
Well, I think the first step, of course, is tapering their asset purchase program, and they're moving toward that. I mean, that has a lower bar for starting that program than actually raising rates. They have to see substantial progress to taper. They have to actually have arrived at their goals in order to raise rates. They're moving toward tapering. And I think, John had mentioned what would be a payroll number that would really shock the markets. I think it would have to be below 500,000, possibly as much as below 300,000. Wow. For the Fed to believe that we're not making the kind of progress that they would like to see. But we're getting there. Now, when you finish tapering the balance sheet, only then will they turn and start discussing when do they hike rates. And the thing about their new framework is that implicit in the framework is you delay rate hikes, and then when you do begin to hike rates, you do so only gradually. The real neutral rate of the economy, jargon alert, will be rising by the time you're getting out to 2023. Even if you're moving down into a one handle on GDP, potential GDP is somewhere around 1.5%, 1.7%. So you can still have a tighter economy enough, lower unemployment rate enough that you can start to raise rates slowly. It's just a sensitive economy that you're not going to be able to raise rates quickly. I don't believe in that narrative.
Can you explain to me a political system, John, that can accept a 1% growth rate?
Right now, for a president and an administration that wants to do something about the labor market and do a whole lot more. Ellen, you've just posed a really tremendously difficult conundrum for this Federal Reserve. If these supply constraints persist, how the Fed can respond to that? Let's just say they persist into the new year. What does this Federal Reserve do, Ellen?
So, John, it depends on just how much participation has changed. Has it changed structurally? I mean, I think one thing that the Fed has been looking at and that we've been following closely is that the rate of retirements has been soaring, and much more so than demographics would suggest. It's very easy to point to that cohort and say most of them are not coming back, even if you have a strong economic growth backdrop. But others that make up about probably two-thirds of the drop in labor force participation are for other reasons, and if you have a very strong economy, you can bring those back. And so it has been critical for the Fed to remain accommodative, coupled with very stimulative fiscal policy. It's when we get out into 2023, if you've still not seen the pickup in labor force participation, if it looks much more structural than anyone had imagined, then it can bring the Fed to redefine what does maximum employment mean to them. Yeah. And it could signal much more inflationary pressures than the Fed would have thought at that point.
Ellen, we just have about a minute left. You've been one of the most accurate jobs market forecasters going forward. One reason why is because you look at high-frequency data. Right now, what is the high-frequency data telling you about how the Delta variant and fear of the spread has put a crimp in the labor market and progress there?
Yeah, Lisa, so it is critical to bring those into our forecasts, even if we're judging it from a qualitative perspective. I think if I'm concerned about today's payroll report, it would be there have been signs more of late that you've got a slowdown in some of those mobility data, the daily data that we get. And we have an AlphaWise team that produces large-scale surveys for us, and our latest consumer survey did show that that vaccines, that people have topped out in terms of the rate of folks that are getting vaccine, but that the concern over the Delta variant surged, and that's just in the last 2 weeks. So self-policing will come back as a jargon alert again. Self-policing, which leads to more cautious behavior and can dampen some of this business activity and further reopening.
Ellen, just quickly before you run, what's the number again that you and the team are looking for?
We're looking for just above a million, 1.025. We're near the top, John.
There we go, 1.025. Alan, thank you. Wow. It's good to catch up as always. Alan Zentner of Morgan Stanley, the chief US economist. Always tremendous to catch up with Alan on Payrolls Friday. They're looking for 1.025. The estimate today, Tom, 855 the average, the median 870.
May 7th. That's all I got to say, John.
Is that what you think, Tom?
I'm completely humbled by this natural disaster that we're in. John, you and I and Lisa see it anecdotally in the 3 zip codes we frequent. All of our viewers and listeners see this across the nation. It is not normal economics.
Most people in this market remember May 7th. For those of you tuning in that do not, May 7th was the April jobs report. Lisa, we were looking for 1 million. We got 266,000. This week's been confusing. ADP report was really soft. ISM was really, really hot.
This time is different, though, in terms of the vaccination rates and in terms of the reopening, at least that I feel. Walking through Midtown, walking through different neighborhoods in New York City, it does seem like people are coming back to some sense of normalcy.
Price of this market's different. 125.66 on 10s against pushing 160. Back when we had that read. Your equity market, futures positive 3, advancing 0.07% on the S&P. From New York, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro, on radio, on TV. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. United Airlines says workers must get vaccinated against the coronavirus. It's the first major U.S. carrier to impose the mandate. United says employees must upload their injection record to a company database no later than October the 25th. The Senate is heading towards a weekend vote on its $550 billion infrastructure legislation. Senators huddled on and off the floor to discuss final changes to the bill, which is 2,700 pages long. Even if the bill is passed, it faces an uncertain future in the House. There are growing signs a coronavirus Delta variant risks slowing the pace of the U.S. economic recovery. Some events, like the New York Auto Show, are being cancelled due to virus concerns. Meanwhile, Bank of America says a pullback in credit card usage could partly be due to the surge in cases. And Bloomberg's learned that China's DD Global may give up control of its most valuable data. It would be part of an effort to resolve a Chinese regulatory probe into the aftermath of its controversial IPO in the U.S. The data is key to both the business of the ride-hailing giant and the Chinese economy. Byron Trott doesn't like being called the billionaire's banker. Now it turns out he is a billionaire banker. According to the Bloomberg Billionaires Index, the founder of BDT Capital Partners is worth $3.6 billion. The firm now manages $26 billion. It's taken 2 companies public this year. Trott has advised some of the world's most successful investors, including Warren Buffett. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's never been this unrewarding. And 2, 3, 4 years ago, people were asking me, are we in a high-yield bond bubble? And I would say, no, we're in a bond bubble. Interest rates were low, which means that prospective yields were low. Today, we're in an everything bubble.
We are in an everything bubble. The words of legendary investor Howard Marks of Oaktree Capital, the co-founder and co-chairman. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures +2 on the S&P. We advance 0.06%. We are 42 minutes away from the payrolls report in America, and yields are higher by 3 basis points to 125.50. Tom Keene, your estimate all over the place, somewhere between 850, 870 going into the print.
Here's where the agreement is. And John and Lisa and I, well, we rarely agree. We get in a room once a year, and part of our agreement is we have to do a real yield brief every Friday to get Ferro ready for his afternoon soiree. We do that now with the former president of the New York Federal Reserve System, of course, with Goldman Sachs for years. William Dudley joins us this morning. Bill Dudley, you are focused entirely on the land of John Ferro, which is the real yield. How do we get out of the conundrum that Mr. Marks just described?
Well, the conundrum is by intent. The Fed is buying assets, and by buying assets, they're forcing people to hold more deposits than they want. Those deposits earn zero. And so the response to that is to buy bonds. Negative real yields now are touched minus 1.2% last week, in the past week. That's the lowest on record, going back to the 1990s when TIPS were introduced.
Yeah.
So it's a pretty interesting environment where real yields are hitting record lows at a time that the economy is in recovery, and inflation on a year-over-year basis is at 5%. It doesn't really fit together very well.
You mentioned the word intent. I'll bring in will as well. Bill Dudley, the key thing here is the mystery over the will and intent of the good people at the FOMC in this original moment. What would you suggest is their will and intent into the end of the year?
Well, I think their will and intent is to make financial conditions very accommodative, to provide as maximum support to the economy, to get all the people that are unemployed currently because of the pandemic back to work. They've talked about making substantial further progress towards their goals of maximum sustainable employment and price stability. They basically told us they've made some progress, but they haven't quite satisfied that substantial further progress yet. And depending on what the payroll employment report is today and maybe next month, maybe they'll have satisfied that requirement, and then they'll start to begin the taper process.
Bill, demand is robust. It's really good. Big question is, will supply arrive? That's where the hope is at the Federal Reserve. Do you share that hope, that faith that supply arrives and the participation of this workforce will recover to where it was?
Well, we're going to find out a lot in the next couple of months when schools go back into session and the unemployment compensation benefits end. Right now, we have a bit of a tension between what we're seeing in terms of job openings, record job openings, and what we're seeing in terms of labor markets. It's still a big shortfall of employment relative to where we were in February 2020.
We've been talking all week, Bill, about the fact that the Fed probably is not going to materially shrink its balance sheet. This is one of the reasons why you attributed yields as being as low as they are. You said that they should be higher. It is for the Fed's participation in the market that they are as low as they are. Do you agree? Do you think that the Fed is going to keep its balance sheet either at this pace or higher for the foreseeable future, just based on where we are economically and based on where we are with respect to the low interest rate regime?
Well, they're hoping they're going to be able to gradually shrink their balance sheet, but there's three steps. First, you do the taper, then you lift short-term rates to a reasonable level, let's say 1.5% or so, and only then do you actually start to run the balance sheet off. The balance sheet is huge right now, so one, it's going to take a number of years before we even start to run off the balance sheet, and when we do it, it's going to take a long time to get it back to a normal level.
What's the consequence of having an $8 trillion Fed balance sheet for the foreseeable future or higher?
Well, I think it basically means that there will still be downward pressure on yields until the Fed Reserve ends the asset purchases and then begins the runoff of the balance sheet. And this does put downward pressure on long-term interest rates, no question.
Bill, if you were still at the Fed, what would you say to Governor Waller after his speech this week? What would you say to him? Would you reach out privately, get on the phone, send an email? What would you do, Bill?
Look, I think it's a tricky situation for the Fed in terms of getting the timing exactly right, and reasonable people can differ about when it's time to pare back the rate of asset purchases. I think the big wild card here is the Delta variant and how that's leading to a rise in coronavirus cases. The payroll employment report we're going to get in a bit is really looking in the rearview mirror. That's where we were in mid-July. Real question is where are we going to be 2 or 3 weeks from now?
Dr. Dudley, Mr. Ferro has been impolite, so I'll go even worse. Let's go to Lawrence Meyer of Washington University at St. Louis and his wonderful monograph, a short little book on Alan Greenspan. I do think seriously, Bill, that many of our listeners and viewers really don't understand the process that this chairman goes through with the good people around him, including the vice chairman from Columbia University. How is the Powell decision-making tree different from what Lawrence Meyer described as the Greenspan dominance?
Well, I think it's more of a consensus-building process. People talk about the big three, the chair of the Fed, the vice chair of the Fed, and then the vice chair of the Federal Open Market Committee, the president of the New York Fed, John Williams. Those three get together frequently and discuss what's the appropriate course of policy, what should the FOMC statement look like. So it's not just one person setting policy. It's the three people sort of driving the process forward. And then, of course, you have to bring the other members of the FOMC along with you.
Bill, your insight's valuable, and I'm looking forward to the latest column coming out a little bit later this morning on Bloomberg.com and, of course, on the Bloomberg terminal. That was Bill Dundee there, the former New York Fed president and Bloomberg opinion columnist. As we wait for payrolls, Tom Keene, 36 minutes away.
36 minutes away. And again, John, I'm going to go back to equity dominance here with the VIX 17.12. The VIX improves this morning. All in all, John, I'd say the tape modestly improves. And what Ellen Zentner said there, you need 500,000 or so non-farm payrolls to really shake up the system there. That's a little bit below some of the other analysis.
I'm going to go to the get back to work effort, and United Airlines taking it one step further.
Yep.
Lisa, they were asking new hires a couple of months ago to provide proof of vaccination, and now they want the full workforce to do the same by October 25th. Get it done.
It's fascinating to see how different the approaches are of different corporations with respect to either mandating it or trying to encourage with $100, or if Tom had his way, $1,000. In the meantime, I just want to point out, do you think that Rich, John, and Jay have their own table at the Fed that they sort of sit?
Rich, John, and Jay.
Yeah, that they like sit at and sort of click on the Federal Reserve.
Very informal and casual.
That they
sit away from people.
This is, they sort of get together on their own. They're kind of,
like
the cool kids.
The back of the school bus.
Yeah, they're kind of the cool kids that, make the decisions.
You don't go down there and talk.
Exactly. I mean, because they're the ones that are sort of the big three making the decisions.
And President Bullard's down the front causing trouble.
He's the one throwing spitballs.
This is real value-add stuff.
I try.
Coming up in the next hour, Jill Carey-Hall of Bank of America Securities, JP Morgan's Jim Glassman, Jeff Rosenberg of BlackRock. It's the big countdown to the payrolls report. 35 minutes away. 850, 860, 870. It's all in and around that kind of number. That's the estimate. Looking forward to full coverage right here on Bloomberg TV and radio. With equity futures up 2, we advanced by 0.05%, and your 10-year yield in and around 125, 126. With Tom Keene, Lisa Abramowicz, Jonathan Ferro on radio, on TV for our audience worldwide. This is Bloomberg Surveillance.
The economy, the empty cubicles that you've seen across the country, it has not stopped.
We've been waiting for the supply to pick up, and supply is exploding.
We've taken wealth from the public sector and we've given it to the private sector.
We're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained?
Now it's time to sort of pull back both the fiscal as well as the monetary stimulus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Jobs Day. In this hour, we will look at the American labor economy, what it means for bonds. Jeff Rosenberg with us, what it means for the economy. Jim Glassman of JP Morgan, and what it means for this stock market. John, the markets will react.
Equities record highs, Tom, on the S&P 500, the NASDAQ record highs over in Europe through the week as well. Demand is really strong. Will supply arrive? That's the big story. It's mission get back to work. And to what degree, to what extent are the Delta variant fears, Tom, derailing that process?
What I see in the tape, what's actually happening, as Subrata Rajappa mentioned at SocGen, the gloom and doom, John, is overdone.
125? Overdone in the bond market.
Come back a little bit.
Negative 1.2%. Real yields overdone in the bond market. Tom, here's the issue. How many times have you and I heard that over the years? That yields are too low, and then they keep going lower.
And talking to Bill Dudley there, former president of the New York Fed, he's thinking very much about getting the real yield back. The dislocations in the market, Lisa Abramowicz, are part of not only this jobs report, but the one coming up for August.
And the idea, not only with the headline number, but some of the details. And it was interesting to me that Ellen Zentner of Morgan Stanley really focused on the broad aspects of this employment report, in particular, wages and participation rate. On the wage front, just want to bring you this headline out of the Dow Jones Newswire. Walmart is giving weekly bonuses to keep its warehouse workers. How much are some of these headlines, these anecdotes, going to play out in hourly wages going up at a pretty dramatic pace in this latest report?
Really well said. And also the United Airlines headline. We'll get to that in the hour. So much to go on right now. And what's so important, folks, about this hour on radio and television nationwide is it's about the markets, the bond market, yes, the American economy. And John, again, the stock market, how they react.
Let's get to the stock market right now on the S&P S&P 500 coming into Friday, record highs right now, up a couple of points, +2. We advanced by 0.03%. We've walked you through the bond market, 124.99 on 10s, had a little look at 126 earlier in the session. Yields higher by 2 or 3 basis points. Euro dollar negative, the euro weaker, dollar stronger, euro dollar 118.03. Crude just south of 70, had a little look at a 70 handle earlier in the session, 69.86 right now. And here are the numbers you need to look for in about 27 minutes time. 870, 870,000 is the median estimate, and the range. How many times have we done this year? The range is wide, wide, wide.
Yeah.
1.2 million at the high end, 356K at the low end.
Home on a range. Here's a number I care about, and it goes to the real yield. See it this afternoon on Bloomberg Television. -1.10 on the 10-year real yield. That is an artificiality all of America must deal with. All corporate officers must deal with that, which of course means the stock market. Jill Carey Hall starts us strong in this hour with Bank of America. What is your Standard & Poor's estimate a year out, Jill?
So we're at 3,800 on the S&P 500 for year end. So we are expecting that the market will end the year lower rather than higher. And I think, you know, a lot of the good news has really been priced into the market this year. You know, I think it's been about earnings coming through, which we've seen this earnings season, another really big beat so far. But you know, multiples are very elevated on the index. The sentiment indicators that we track have been growing increasingly bullish, and our Wall Street equity sentiment measure is very close to a sell signal. And you know, I think earnings season suggests that a lot of the good news has been priced in. Companies that beat just aren't outperforming very much, which we saw last quarter. And outside of the last 2 quarters, the last time you saw that happen was around March of 2000.
Jill, you, Savita, and the team looking for a down market then. Walk me through the sector preference within that call.
So, you know, we still like some of the cyclical areas over defensive. So we're overweight energy, we're overweight financials. I think where interest rates are right now, we would expect them to move higher rather than lower. And we still like value over growth. I think from you know, especially with the jobs report this morning, I think wages are going to be a very important metric to continue to watch. So we're underweight some of the more labor intensive areas like consumer discretionary, where, you know, so far for the S&P 500 margins have generally held up, but this earnings season you are seeing a big surge in companies mention you know, labor and wage pressures, where that had been one of the more benign sources of inflation prior to this. So I think a lot of the areas of the market that have a high ratio of employees relative to their sales are going to be some of the areas that, you know, could be more challenged as we move forward if wage inflation continues to accelerate.
Jill, you and the team have done some tremendous work on that, and I've enjoyed reading the research, so thank you. Thanks for providing it. The call for value over growth, I want to understand from your perspective whether there is a bond market call that underpins that view. What is the bond market call, if there is one, that underpins that view?
Well, look, I think there's a number of things, and really what we found is that the profit cycle has been a bigger driver of value versus growth than interest rates. So, you know, really you want to own value when growth is becoming more abundant within the market. Profits growth on a trailing basis is still accelerating. And, you know, the value stocks within the market are actually slated to see better earnings growth over the next 2 years than growth stocks. So, you know, you don't need to pay up for expensive growth if growth has become more abundant and actually better within the value segment of the market. And these value stocks are still generally cheap and under-owned relative to growth stocks. So, you know, I think there's a number of drivers that can even be more important than interest rates in terms of owning value over growth right now.
Jill, you haven't mentioned the Delta variant at all, even though that seems to be mentioned in every other article about the market trend so far. That has seemed to put a crimp in some of the cyclicals and some of the small cap names that I know you track so well. When do you start to care about the Delta variant? I mean, is it impacting your appreciation for some of these stocks, or do you think that this is actually a buying opportunity?
Well, look, I think it's a risk that we're all going to continue to monitor, and there's a lot of uncertainty around it. But I think from a reopening and recovery perspective, there's certainly been pockets of the market where we've seen this grow to become more of a concern. But you know, in terms of other areas, you know, leisure, you know, the overall services spending recovery, I think that that's something that we're going to be watching the data very closely on as we move forward. But, overall, as we progress throughout this recovery, smaller stocks are obviously more exposed to the reopening, to the shift from goods to services spending, and they haven't really reflected much of that recovery at all. So they've still been trading at this, double-digit historical discount to large cap peers, even though they're slated to see a better earnings recovery and have more exposure to some of these reopening trends. So, the margins for small caps this earnings season have also still been accelerating despite the pressures from inflation. So, I think there's more room to run on small versus large. They've given up their outperformance year to date on some of these concerns, but I think it's going to be something that warrants continued monitoring going forward and is one of the biggest risks certainly for the market.
We're starting to hear from other Wall Street shops that they are starting to project out to the end of 2022. Have you done that? Does this down market continue through then as people have brought forward so much of the earnings ahead of the cycle?
Right. So we don't have a 2022 target yet, but when we've looked at, what's the best predictor of very long-term S&P returns on a multi-year basis, valuation doesn't tend to be a great predictor over the next, year or so. If you're a longer-term investor thinking about equities over, the next decade, that's where, returns from our long-term valuation framework are going to be, much lower than what we've seen by our frameworks than, prior years, just given the fact that multiples are so elevated right now. So, if you're a long-term equity investor, you're going to see much more tepid annualized returns for equities than we might have seen a number of years ago. So, when you add a dividend yield onto that for the S&P 500, we still favor equities over bonds at this point, but certainly that asset allocation decision has grown, less skewed toward equities than it was a number of years ago.
Jill, thank you. We've got to run and get ready for that payrolls
Thanks.
report. I know you have too. Jill Carey-Hall, Bank of America US equity strategist, looking for 3,800 on the S&P. They're looking for a down market. This S&P 500 right now, all-time highs into Friday. We're positive, 2 points on the S&P, up 0.05%. Mohammed Al-Arian just publishing in a Washington Post, Tom, an opinion piece. Here's the headline. The Fed's ultra-loose monetary policy could hurt both the economy and Biden's agenda. I'll catch up with Mohammed in about 50 minutes' time.
These are the back and forth, the cross currents, John, and you say to yourself, how do you go from Costin at Goldman Sachs over to what Jill Carey's talking about at Bank of America? The gap there between Bank of America and Goldman Sachs, you can drive a Mack truck through that.
It's a 900-point spread, Tom.
Yeah.
On S&P 500 year-end forecast.
People are going to go, wait a minute, explain that.
There's
explain
5 months
it, John.
left. I can't explain it for you, Tom.
But
Lisa, there's 5 months left.
Lisa can.
There is an explanation, and they've got divergent views in interest rates. And a lot of the Goldman Sachs call was underpinned by this belief that rates would remain low. If you believe that rates are going to remain that much lower, that's not going to upset the apple cart when it comes to equity valuations, especially with a slow growth economy in the longer term.
I would go further. I would say not only is it a rate differential call, but it's a nominal GDP differential call where Goldman Sachs is looking for some animal spirit in 22 and on, and Bank of America has a much more cautious view.
It's where they think the earnings will show up.
It's
and
where,
you heard that from Jill there, Lisa.
Well, the earnings will show up, but also there's a question of we don't understand Treasury yields. They have continued to go down despite all of the calls for them to go up.
I said this in a previous hour, and I know the two of you agree. If I could tell you the print, and I do not have the print, the White House has the print. If I could tell you the number that was coming out in 19 minutes' time, could you tell me how this bond market would respond?
Absolutely not.
Not many people can do that with a degree of confidence, and that's where the confusion lies. 125 on 10s, yields higher by 3 basis points. Your equity market up 3, plus 3, with positive 0.06%. Positive 0.07. Did you say something, Tom?
Dow futures
from
up
New York.
32.
It's a beautiful morning. Good morning. This is Bloomberg.
With the first word news, I'm Rishka Gupta. The U.S. Senate is set tomorrow to approve that $550 billion infrastructure package. It will be the largest infusion of cash in decades for roads, bridges, and other domestic projects. The bill still faces challenges in the House. Speaker Nancy Pelosi has said she will hold on to the bill until the Senate also acts on President Biden's largest spending plan. United Airlines says workers must get vaccinated against the coronavirus. It's the first major U.S. carrier to impose the mandate. United says employees must upload their injection record to a company database no later than October the 25th. And public universities in the U.S. face student lawsuits over coronavirus vaccine mandates, according to Dow Jones. Lawsuits challenging the vaccination requirements have been filed in Indiana, Connecticut, California, and Massachusetts. Students claim they have a constitutional right to go to college unvaccinated. Singapore will take advantage of having one of the best vaccination rates in the world. The Southeast Asian Trade Center announced plans to ease COVID restrictions on daily life. It also will begin slightly loosening border controls. 2/3 of Singapore's population is now fully vaccinated. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You're living in a world of excess supply, and therefore what you need to do is you need to create the liquidity that allows inflation rate to actually not get sucked into a deflationary bias. And this has been the Fed's ongoing risk.
It will take about a second after that payrolls report drops to have a debate about what the Fed will or won't do next. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. We are 12 minutes away from a payrolls report in America. Your equity market looks like this, up 2 on the S&P, +2, positive 0.05%. Outside of that, yields are higher by 2 or 3 basis points on 10s to 124.99. Euro dollar negative, down to 118.07. Tom, we're looking for something like 870 now.
Yeah,
870 is the median estimate going into the jobs report.
Stay with us on radio and television. It's going to be an eventful number of hours. The Secretary of Labor with John Ferro will do that at the 9 o'clock into the 10 o'clock hour. John, before that, Dr. El-Arian with that important Washington Post essay.
And Rick Reeder as well from BlackRock. So we'll catch up with Mohammed, we'll catch up with Rick, and we'll ask them basically the question that led to that essay from Mohammed today in the Washington Post. Will this data that we're starting to see over the last few months, inflation more specifically, overwhelm the goals of both the Federal Reserve and of this administration too?
Let's tie it in right now off the El-Arian essay where he talks about a busted price mechanism because of a Fed and their original strategy. James Glassman joins us now with J.B. Morgan Chase. This is a lovely tradition with his true expertise on the labor economy. Jim Glassman, do we have a busted wage mechanism?
We have a lot of dislocations that are making it very difficult to read. I think you don't really know what's going on. When you have 8.5 million jobs shy of where we need to be, a lot of those jobs are folks who work, lower pay or who work in the hospitality and leisure. I think it's really difficult to make sense of it. What I hear from people though is I think the legacy of this crisis is going to be giving more benefits for workers. Pay is going up, overtime will go up. It's getting harder to find people. You're having to pay more for them. It's also forcing you to automate more. This is, to me, the legacy of this crisis is going to be this step forward in labor productivity and pay.
If we have an increased labor share, does that come from leadership from big companies? What is the mechanism to get the wage up?
It's smaller businesses are going to be struggling the most because they're going to have to work harder to find people. And I hear that story a lot in calls with clients. I think it comes from everywhere. Everybody is feeling this. Everybody is experiencing the shortage of workers. This did not happen overnight. This has been brewing for a good decade. It's related to the demographic shift going on in this country. And I think this is going to be a more favorable story in the years ahead for workers than it has been for 2 decades. Because for 2 decades, all that innovation that moved us from brick and mortar to online really has pushed the share of income going to workers down and the share going to profits up. And that's really the dynamic that's been driving a lot of this national debate about the income divide and the widening distribution of income. I think what's going on now is beginning to shift that and stabilize it.
Jim, there's so much to unpack. You were talking about entering an era of increased productivity with more automation, and I wonder how this fits into the low participation rate that just has remained stubbornly low and frankly has been in a downward trend for the past 3-4 decades. Do you expect the participation rate to continue to go lower, people remaining out of the workforce permanently as some of the more rote jobs get automated and skills are increasingly important?
You know, right now, the decline in the labor force has really been exacerbated by this crisis because particularly hit women more than men. You got responsibilities at home. I think, though, this trend that you're talking about, this for the last couple of decades, this is a structural thing that's been going on, and it's got to do with the aging of the workforce. For example, people who are working age, 16 to 70 years of age, we used to see 200,000 a month. It used to be growing 200,000 a month. Now it's down to 50,000 a month, and that's telling you there's a huge demographic. People are retiring. A larger percent of the population, maybe 30% now, is over the age of 55. A decade ago, it was 20%. So that is a huge change, and we normally ignore this as economists because immigration tends to fill the gap. If we don't have the people for the jobs, we tend to get immigration, and we are not seeing that in the last decade.
Jim, before we let you go, I would love you to weigh in on the point that Mohamed El-Erian was making in this Washington Post column, where he's saying that at this point, the Fed maintaining such an easy policy, the fact that they are maintaining their bond purchasing program as is, despite some of the hot numbers that are coming out, is actually counterproductive, and it potentially could even hamper the agenda of the Biden administration and, frankly, the economy. Do you agree?
No, I agree with the Fed. I think they are doing the right thing. We've got 8.5 million jobs to go to get back to normal. That's where their focus is. And if we can't get people back to work, it's going to create even bigger problems down the road. So I think the Fed's got the right idea. I understand it makes everybody nervous when you see the Fed buying assets and keeping rates low when the economy is making progress. It is making progress, but we still have a long way to go. And when you look at things from the point of view of how much employment do you need to get everybody back to work?
Jim, we've got to run. It's got to catch up. Jim Glassman, JP Morgan Chase commercial banking head economist. You know how this works. At 8:30 Eastern, the number drops and we go to one man. That man is with us now, Bloomberg's Michael McKee. Morning, Mike. Let's go through these numbers, the numbers that you're looking for in about 7 minutes.
Well, the consensus is 858, but as you've mentioned earlier, the dispersion really wide from 350,000 to 1.2 million. Steve Stanley at Amherst Pierpont makes a very good point that our models are basically designed to look at the demand for labor, but this is a supply of labor problem, and it's really hard to figure out how many people are going to be out there that match up with the jobs that are open. So it's going to be interesting to see how the markets react to that.
Michael McKee, the heart of what Jim Glassman just said, with decades of experience, is this is a permanently changed labor economy. Do you believe that, and does the Fed believe that?
Yes, I think both of us do. It has been changing for quite a while because of the participation rate as the baby boomers retire out. But this accelerated that movement now. And baby boomers are the people who are going to be at the higher levels, who are going to be the higher skilled, who are going to be the higher paid. And
right.
And except for you, everybody's quitting. So
thank you.
It's going to be harder to fill some of those jobs.
I wasn't going there, Tom. I promise you. I was never going there.
The third time we've heard this in the last 90 minutes. Zentner, Glassman, McKee.
Yeah, and I wonder if we'll hear it from Jeff Rosenberg at BlackRock. He'll be joining us shortly. With 5 minutes away, Lisa, 870,000. That's the estimate.
And the question is, how much does this matter in the scheme of things? How will the market respond? What's the threshold for the Fed caring, right? I mean, is it enough to get one payrolls report like this without necessarily seeing the effect of the Delta variant and what might happen in September to say the Fed's going to taper?
I said earlier, it's the most important jobs report since the last one until the next one. The next one is September 3rd. And Tom, September 3rd, we'll have this conversation all over again. What does it mean for September 22nd?
Oh, it's a natural. We're in a natural disaster. John, the most important thing today is you had that JOLTS chart up.
Yeah.
Which is a McKee chart. And the fact is that's the dislocation of this economy.
Demand is stellar, it's robust, it's great, it's tremendous. Will supply arrive? Let's run through the price action as we beat the drum a little bit harder going into payrolls. Your equity market up 2 on the S&P 500, positive just 0.04%. Into the bond market, yields higher by 2 or 3 basis points to 124.99 on 10s. Your estimate, 870,000. The previous number, 850K. From New York City this morning, good morning. For our audience worldwide, with Tom Keene, Lisa Abramowicz and Jonathan Ferro, the payrolls report in America is up next. comes the payrolls report live from New York City for our audience worldwide this morning. Good morning. Your equity market unchanged. Your bond market yields are higher. 124.99 with the jobs report. Here's Mike McKee.
All right, John, we are seeing 943,000 jobs restored in the month of July, which is extremely good news, better than anticipated. Those who had the 1.2 million high end are closer than those on the low end. The unemployment rate declines by 0.5% to 5.4%. Now, I'm going to have to look that up and see why that is, if it's a labor force thing. But it is good news that we see that. The average hourly earnings are up 0.4, which is more than anticipated. That is a 4% annual rate, and we saw revisions to the last 2 months that go up as well. So more money, more hours, and more people working. The change in private payrolls, 703,000, a little bit less than we saw in the prior month, and a little bit less than the anticipated amount. So what I'm guessing is we have a seasonal factor in education here. I will check that out, but maybe you take a quick minute to answer the question Lisa's been asking all morning of how the market's going to react to this.
Well, let's get straight to that market action. Mike, thank you. It's an upside surprise. 943. We were looking for 870. Futures are positive. We're up by about 7 points. We're positive 0.16% right now. The bond market's where you get a repricing. Yields were higher. They're even higher now. By 4 or 5 basis points on 10s. We get a 127 handle this morning after seeing 112.58 earlier in the week. If we can have a little look at the FX market, Tom, euro dollar back through 118, 117.95. Tom, we're down there by a third of 1%.
There was almost a pause and then jump started it, not right at 8:30, John, but I'm really watching 30-year bond to see what it does at a 191 on a path to 2%. John, we've done 1.881 million jobs in 60 days. That's how I would look at that with that robust revision.
The yield are higher, the curve is steeper. Mike McKee, straight away, you know how this works. The number drops, and then everybody says, what does it mean for the Fed? Mike McKee, what does it mean for the Fed?
Well, I'm just basically working through some of the numbers here that are important to the Fed, and you look at the unemployment rate dropping as much as it did, and then we look at the unemployment rates for blacks and Hispanics because the Fed focused on that. In June, black unemployment was 9.2%. It drops a full percentage point to 8.2%. Hispanic to 6.6% from 7.4%. That would strike one as substantial further progress. When we look at back to February of 2020, black unemployment was 5.8%. So it's still elevated, but it's come down an awful lot from where it was.
Mike, I know you haven't a chance to dive into it because you're talking and I'm looking, but median duration plummets. This is the duration out of jobs plummets, Mike, to 15.2 weeks from a 19 level earlier. Those are the kind of numbers that give the people under Chairman Powell, the PhDs, some confidence.
Yeah. Now, the issue is this is 1 month, so they're going to say, let's see the September numbers. But yeah, you get a number like this, some sort of numbers like these in September, then that September 22nd meeting could be the taper announcement. That's what we're going to be looking for, I think, at this point. That's probably what the market is going to price. I don't. You were looking at the bond market. I don't know if you had a chance to look at the futures yet, but for Fed funds. But I bet we're going to start to see that move in a little bit from the end of the year.
And actually, what you're seeing right now in the 2 year is you're seeing a pretty a bigger move there than perhaps in the 10 year. As people bring forward the potential for rate hikes, but it's not that big of a move. It's actually surprisingly muted considering the fact that so many people put so much emphasis on what the Fed does. I'm looking at hourly wages. I find this fascinating. Hourly wages increased more than expected, and year over year, a 4% increase in hourly wages versus the expectation for 3.9%. The average hourly work week actually increased as well. How significant is this? All metrics point to more hours and more pay.
Well, there's two things with the average hourly hours worked. That is all that average hourly earnings multiplied by the extra time at work, so more money coming into the economy. Interesting note here, we see that leisure and hospitality led the increase in jobs, 380,000. Bars and restaurants up 253,000. Tom doesn't have to wait as long to get his drink this time. Those are the lower paid jobs. And so if that many lower paid people are coming into the labor force, it should depress earnings, and yet earnings are going up at a faster pace. So it does show companies are paying up to get people back to work.
John, quick data check before we get to Jeff Rosenberg. I'm looking at a bond market that picks up steam here, higher yields.
Yeah, that's where the action is, Tom, because equity futures aren't doing much at all. We're up 3 or 4 points on the S&P, barely 1/10 of 1%.
Right.
Yields are higher. The curve is steeper. The yields are higher on a 10-year by 5 basis points to 127. Tom, it's an upside surprise. 943, 870 the estimate, and some really tiny revisions as well.
Lovely revisions. Jeff Rosenberg joining with BlackRock. And what's so important here is holistic and fixed income and doing wonderful work in multi-strategy as well. Is it a regime change today, Jeff Rosenberg, when you see the revisions, when you see 1.881 non-farm payrolls over 60 days, does it shift the BlackRock view?
You know, it's a really good question, Tom, because I was thinking the exact same thing, that, you know, we've had a lot of kind of negative surprises, you know, focused really on the Delta variant. You know, it's important to remember that this payroll report is really pre the CDC mask wearing change in guidance. It doesn't really incorporate some of those more recent changes. Yet, to the extent that we follow the pattern that we've seen in India and the UK, where the variant surges, but it's not a permanent surge, you know, we could be seeing kind of the peaking of the negative news that has been really about the second derivative and the slowdown, and that's manifested itself in a pretty protracted rally in interest rates, you know, since interest rates peaked at the beginning of March. I think the next focus here, and you were just talking about it in terms of average hourly earnings, Mike McKee spot on. It's really hard to digest and decouple the mix shift from the underlying data, but it's a strong print, even with the mix shift that Mike was highlighting. And that's really going to turn the focus on inflation. If we add labor market strength, and let's be clear, this is a very strong report across all metrics. There's very little that you can point to here that's disappointing. And if we add to that, you know, some signs of a broadening out from that inflation that we're seeing in the wages here, you know, this could be that regime shift in terms of the direction that we've had on interest rates that you were asking about.
Jeff, if the Fed meeting was tomorrow, what would they decide?
Well, I think you hit it, or someone talked about the taper discussion. You know, it's important here. The Fed is very focused to separate the interest rate tightening path from the tapering discussion. And so when you look at that bond market reaction, and earlier, you know, we were talking about the 2-year versus the back end of the curve, still a pretty muted response in the very short maturities of the Treasury market. The actions in the back end of the curve, and that tells you that, you know, the market is separating the path of tightening from the pace or the calendar on tapering. I think, you know, if anything, it pulls forward maybe tapering, but the Fed's being very clear they want to avoid the taper tantrum. And remember, the taper tantrum was about the market conflating tapering with earlier tightening. This is not going to be an earlier tightening, but it could be an earlier tapering.
And Jeff, that's exactly what President Kaplan tried to do this week, aggressively de-link his commentary about QE from any kind of idea about hiking rates anytime soon. Mike McKee, I want to bring you back into the conversation. Is there reason to believe that this can persist? These jobs gains can persist into September? And was this a stress test for the theory that if you remove additional unemployment insurance, the workers will show? Some people have made that argument. I don't hold a position here. I'm just wondering, Mike, is there proof of that this morning?
No, there's no proof of it this morning. We don't have data that show that. The research that has been done suggests there has been no effect from it overall. In about 2 weeks, we'll get the state employment numbers, and we'll see if any particular states that cut off unemployment benefits see a rise. But one thing that may be at work here, John, is that in the summertime, schools are never in session. So the daycare issue may have not been a problem in the sense of the seasonal adjustment that is done, because they expect people to be out of the labor force to a certain extent taking care of their kids. And let me also mention that The education component that was expected to add to jobs certainly did. Jobs in education, 223,000 more in the seasonally adjusted area than in non-seasonally adjusted. So they've added 223,000 jobs to the total. Otherwise, we would have had 720,000. Yeah. So definitely a major seasonal adjustment question here. But the issue is, does anybody at the Fed really care about seasonal adjustment when they're trying to think of whether it's substantial additional progress?
Jeff Rosenberg, as an investor, what do you do with this information?
Well, as we talked about, I think this is a possible shift here in the rate dynamic. We really have to follow this up with some inflation data if that's really going to be the case. But just going back to the labor market piece, because you look at what's driving the Fed and market expectations around the Fed, and it's labor markets and it's inflation. And on the labor market side, this is certainly contributing to accelerating mostly the taper discussion. I think the Fed's going to do a lot to try to separate out taper from tightening, and I think that's the main takeaway. I want to just add that there is some little piece of information here. That participation rate did tick up 1/10. That's quite helpful. We're going to be focused on that participation rate as we roll off the rest of the unemployment insurance to see whether the supply side starts to ease and you start to see the labor market grow from that end.
Jeff, does this report change the balance of risks with respect to overheating in the economy or perhaps going into more of a stagflationary environment?
I don't think it does. I mean, I think that you've had that balance of risk. Look at Clarita's speech from a couple of days ago, and I think the balance of risk that he highlighted is to the upside on inflation. And while that, there's certainly hawks and doves both within the Fed and within the market, I think that balance of risk to higher inflation is something we had before the report, but certainly this report, particularly, what Mike highlighted on average hourly earnings, only reinforces that risk on the balance of risks being towards higher inflation.
John Ferro, Jason Furman with a blistering tweet. He's never seen a more constructive report like this. He calls it a wonderful set of data. Neil Dutta is heated that this is a massive start to Q3.
It's what we all wanted to see. Jeff, it's good to catch up, sir. Jeff Rosenberg of BlackRock. These are the numbers. If you're tuning in a little bit late, where were you? 943,000, the number. 870 was the estimate. It's a tidy upside surprise and a really nice upward revision as well over the last couple of months. In the market, this is what it means. It means NASDAQ futures are lower by 1/3 of 1%. S&P 500 futures are firmer by about 1/10 of 1%. And the why lies in the bond market, doesn't it? Once again, that's what we've been queuing off over the last couple of months. Your 10-year yield up by about 5-6 basis points, approaching 128 on 10s at the moment after having a look at 112, Tom, earlier in the week. That's quite a turnaround.
We got to stay forward here. I'm going to dovetail this report and what we see right into the Ellerian essay in the Washington Post. I mean, it's not that he has to modify the essay, but he may be even more strident about a need for Fed action.
And that's the conversation I'm going to have, Tom, at the top of the hour. Mohammed Al-Erin of Queen's College, Michael Collins of PGIM, BlackRock's Rick Reeder, Anastasia Amoroso of iCapital Network. The best lineup worldwide to get a reaction to the payrolls report. That show starts, Tom, in 17 minutes' time.
We're going to continue the Secretary of Labor to be with us later in that hour as well. Michael McKee, I want to go to you with a sea change here. And as John mentioned, is it a Fed meeting that's changed and all that? Buried in this report are two reports. There's non-farm payrolls, and there's a completely different report. In the old days, I remember David Malpass was the only one that paid any attention to us. What does the household report say versus the more popular non-farm payrolls?
Well, it does give us an answer as to why unemployment fell as much as it did. We didn't see a huge change in the civilian labor force, 261,000. Last month was 151,000. So it isn't that many more people coming in and looking for work, but it was a lot more people getting work. The number of people who got jobs, 1,043,000, whereas 782,000 fewer people reported being unemployed. So this is the exact thing you want to see in terms of good news for unemployment and why that happened. Also, in terms of employment, we saw, as I said, 1,043,000 come back, get jobs. In the household survey, they had declined last month. That had declined last month, so a nice rebound there. So overall, the household picture, very good. And of course, the household survey includes people who are self-employed, gig workers, people like that, which the establishment survey doesn't show.
Yeah. You know, I want to just double down on the average hourly earnings year over year, an increase of 4%. We've been talking about this since the report came out. But really, if you strip out some of the disruptions that were compositional in nature over the past 15 months, this is the highest read in decades in terms of wage inflation. At what point does this really start to matter to the Fed? Are these numbers clean enough for this to indicate, yes, pay is going up, and yes, this will bleed through into underlying pricing in a material and sustained way?
Yeah, we're going to need a lot more information, Lisa. Obviously, as I mentioned, because the jobs coming back are lower paid, there is something going on. But is it a one-off? Our companies basically spending more money to get people back to work, and then they stop raising pay. That's what the Fed would be concerned about. And a lot of what people are getting is one-time bonuses to come back that won't recur. So we don't know yet whether there is a wage component to a wage price spiral. We know that prices are up. The Fed doesn't think that will continue, and we don't have the evidence yet on whether wages are going to continue.
And Tom, can I just say that actually there was an article in the Wall Street Journal showing that when they gave these one-time bonuses, existing employees said, hey, what about us?
Yeah.
So you started to get bleed through raises and compensation to everybody, because otherwise people would leave. So it does have a bleed through effect, even if it's just a one-time thing.
Well, you saw that in the Vanguard bond show where they do 1,000 for unvaccinated and 1,000 for vaccinated.
Oh, you noticed.
As well. Michael McKee, thank you so much. Much more from Michael McKee through the morning as he dives into this data. Gina Martin-Adams now on the equity market consequences. Gina, I see a churn to equities, but nevertheless, a VIX that signals a bull market. Neil Dutta at Renaissance suggests this is a bang-up start to Q3. How will that change the Standard & Poor's estimate game?
Yeah, I think that analysts are still pretty cautious, frankly, on the outlook. And certainly what we've seen over the course of the last 6 weeks or 8 weeks or so is a rotation into more defensive strategies, really driving the market higher. So to the degree that we have much faster than expected growth and persistent growth, those two things are very important. If we get both of those over the course of the next several quarters, we're going to continue to see upward estimate revision. So far, analysts are only revising estimates higher because second quarter numbers beat. And that's been consistent throughout the entire pandemic. Analysts are very cautious with respect to the outlook. And even though numbers are still going higher, they're only going higher because companies are telling them that they should go higher. It's not that analysts are getting overly optimistic. So if we continue to see numbers like this, we're going to see upward estimate revision all the way into 2022.
How has use of cash changed, or your guesstimate of use of cash? Robert Schiffman published moments ago of a 40 billion share buyback at Microsoft. They've got the powder to do that, et cetera, et cetera. In all of Bloomberg Intelligence, how has use of cash changed to sustain this bull market?
Yeah, so far this year, it's been all about buybacks and M&A. Those two things have really been the dominant factors behind cash utilization by companies. So to the degree that they're willing to part with their cash, which is still a limited amount of companies doing so, they're spending it on re-engaging in buybacks that they cut in 2020 and increasing buybacks over time. They're also buying companies. We are seeing M&A trends improve, and we've seen that really since 2020. What they're not doing so far, and I think where we have the greatest potential to sustain a longer term, faster pace of economic recovery, is capital spending. Companies are still not parting with their cash in the most optimistic method, and that is spending it on future business potential outside of buybacks and M&A. So we've got to see capital spending improve. There's certainly capacity to do so. Just to get back to average share of capital spending relative to sales, we should see capex rise 25% over the course of the next 12 to 18 months.
Yeah.
If we get that kind of figure, that's going to increase the confidence that analysts have and certainly increase the durability and the perceived durability and rate of growth that we likely are going to see over the course of the cycle.
Gina, stick with us. We're just sort of parsing through the numbers. Michael McKee is looking at the more granular aspects of this report. And when we talked about the dissonance between corporate earnings coming in so much hotter than people had expected, yet economic data lagging behind, perhaps the economic data just hadn't caught up with itself, Mike. What are the details?
Well, we're looking at revisions to the prior months. You add in the numbers that were added back for June and May. 938,000 jobs were created in June. We had thought that was 850, so a significantly better report for the month of June, and total 119,000 over those 2 months. So job creation has been a lot stronger than we had thought it was. We had some reports we thought were disappointing. Turns out they weren't as bad.
Meanwhile, Gina Martinette still with us, and I'm looking at the action in the equity market in response to this. Pretty much as you would expect, NASDAQ futures way underperforming the S&P, which is basically flat. NASDAQ futures are down a little less than 0.5%, or they were in just a couple minutes ago. I'm wondering, from your perspective, if the NASDAQ can post gains through year end if Treasury yields continue to rise.
Very unlikely. At least they will lag. The NASDAQ should certainly lag the S&P 500. The more cyclically oriented, sort of value-centric segments of the market should rise faster in an environment where rates are rising and inflation expectations are rising. In my mind, the recovery that we saw in the NASDAQ and big cap tech in particular over the course of the last couple of months was really about analysts and investors generally getting a little bit more cautious about the growth outlook. So if you continue to have surprises on growth, you continue to have surprises on inflation numbers, that trade depletes over the course of the rest of the year.
Gina Martin Adams, thank you so much. Too short a visit this morning. We now go to Bloomberg Intelligence. Ira Jersey, just wonderful in the short-term trust market, but also bills, notes, and bonds. What kind of move, Ira, is a substantial move now for this bond market? Let's use the 30-year bond, 1.91, 7 basis points, 1.93. Where does it click in that this is price down, yield up?
Well, I think it has to be for the 30-year back over 2%. I mean, 2% is just a number. Like 205, 206 is actually a more important technical level here. But I think importantly, and one of the things that the jobs report does show is that we are making some progress. And is this substantial? And the answer to that actually is no, because when you look at the what I call the paycheck of the economy, so you look at aggregate labor income, that's hours worked times the number of people employed times their average hourly wages. And what you see is we're growing now only at 2%. So we're not quite back to the trend we were prior to COVID in terms of the aggregate labor income. So if the Fed's looking at, the entire job market and how that's going to affect the economy and retail sales going forward, this is certainly a step in the right direction, but it's not quite done. So I agree with what Jeff Rosenberg said earlier. I think this maybe helps pull taper forward a little bit. So I do think that we might get taper by the end of the year. Maybe probably not announced in September, but November for an immediate taper. And then from there, the question is, how fast do we then grow beyond that? And that will ultimately determine when the Fed actually starts.
And for non-pros out there, Catherine Judge up at CIBC in Toronto frames the taper in the Q1-ish of 2022. I don't want to put words in her mouth, but I think that's where CIBC is. Ira, what's the differential between a taper in November, you pick the month, or a taper in April of next year? What's the so what of that?
Well, so the so what is twofold. One is the Federal Reserve is still buying a large share of the market right at a time when the Treasury Department is going to actually be decreasing the amount of bonds it's issuing. So it looks like in November, the Treasury Department is going to start issuing less 2 years, less 10-year notes. So as they do that, you wind up with a supply-demand dynamic shifting, where if the Fed was still purchasing a lot of securities, you'd probably get even lower yields than we have now, because the Treasury is reducing supply, and there's still a lot of demand for Treasury securities. Now, and what does that mean? Well, I think in large part it means that it's still going to be hard for the market to have a taper tantrum-like event where we get a 100 basis point move in 2 months. But that doesn't mean we can't move substantially, because when you look at a lot of our models, like we made most of our models show around 1.5% as fair value right now for 10-year Treasury yields. So we still have another 25-ish basis points to go before we kind of get to fair value. And then, typically you overshoot a little bit. So I think it's most likely that by the end of the year, we'll get back into the range where we were kind of the February to May time period, where we were 150 plus or minus a few basis points. And then the market will reevaluate what really is the path of the Fed and the path of the economy.
Ira, when I look at the bond market action, there's more action in the long end than there is in the short end in terms of yield curve steepening, higher yields at the long end, not as much action on the front end. Basically, the indication being people don't expect the Fed to pull forward their rate hiking cycle that much. Perhaps the taper, yes, but not necessarily rate hikes. Do you think that that's accurate? Do you think that that's actually how it's going to play out?
Well, I think that is exactly right, Lisa. I think that's exactly what the market's telling us right now is that, hey, the Fed will be buying less of the market. They'll be taking out less interest rate risk. And because of that, the long end winds up being a little bit more susceptible to sell-offs. Meanwhile, I'm looking at the front. I'm looking at Eurodollar futures, looking at SOFR futures, and all of those, like you mentioned, a little bit at the margin increasing the risk of a 2023 hike, but really not very much. It's more that they're going to go later, but maybe go faster. And that's actually being priced into the Eurodollar market right now.
Faster in a measured Greenspanian way, or do we get, let's clear the markets in November and on into 22 with some real significant rate moves?
Well, I don't think for the Federal Reserve that my personal opinion is they're not going to hike before 2023. I think that there's always some bump in the road that ends up, kind of letting you be a little bit more cautious. And we certainly, even if they start in November, they're not going to be done tapering until June or September, depending on how fast they go. So in an environment like that, the earliest they're going to go is late 22, which is fine. A lot of members, James Bullard and others have talked about late 22 being when they expect to hike. But I think that's a little bit too optimistic because at some point we're going to get some hiccup, and it might not be pandemic related. It may just be supply chains or another trade war, something like that causes the Fed to just pause for a couple of quarters, and then finally they start hiking in 23.
Ira Jersey, thank you so much. With Bloomberg Intelligence Chief U.S. Rate Strategist, I do want to point out, folks, the red and green on the screen is blinky. There's a lot more energy 26 minutes on from this jobs report than I would usually see as well. Lisa, an incredibly important vector and chart from Kathy Jones over at Schwab, where she just takes the good news of this jobs report and says, when do we get back to Valentine's Day? And the answer is 2 years out. Pre-pandemic gets us back to the good news about February of next year.
And this is the key issue. These are fantastic numbers. We need more of them to get back to where we were pre-pandemic. Yep. And really, the markets might be a little soggy in certain corners, whether it's a bond market sell-off or whether it's the NASDAQ dipping low ahead of the open here. But this is great news that people are getting back into the market. Participation is increasing, the hourly wage increasing. All of this is positive for the worker, but there needs to be more. And people keep talking about the millions of people still unemployed, still out of work, which is the reason why economist after investor come on this show and say that accommodation is still necessary. I'm not taking a stand, but that's the argument on the other side.
Andrew Hunter at Capital Economics notes, quote, acceleration. Lisa, can we define substantial further progress as this moment?
No. I mean, we could try, but I don't think that we're in the seat. I think that Fed Chair Jay Powell will say that this is further progress, and it'll be interesting to see when he starts saying substantial. And probably, I mean, all of the Fed officials who've come out, they've said it's not going to be just one report.
How about this statistic removed? Oil bounces back $1. That's important. Lisa, gold down $29, decisively below $1,800 an ounce. I'm sorry, markets are moving to this combined 1.8 million jobs over 60 days.
And the fact that you're combining the two is important. The idea that we had that upward revision to last month so that it looked much worse than it actually was. We actually are having a succession of positive jobs reports, and how much this changes the dialogue is important. I also think what Jill Carey Hall of Bank of America Securities said was interesting as well, which is that a lot of people are looking to consumer discretionary companies and how much they might have to pay their employees more as these wages increase. I mean, we're seeing this across the board, company after company offering all sorts of benefits to bring people online and having to broaden out how much they increase pay throughout their staff.
We're going to keep this dialogue going. This is truly, within this natural disaster we've all faced, an historic day. Coming up, I really want to focus on a discussion with Mr. Ferro, Dr. El-Arian, Professor El-Arian of Queen's College, Cambridge, with that important Washington Post essay. Who does Mohammed El-Arian listen to? Jerome Schneider will join us on Bloomberg Radio in moments. He is outstanding on the short-term dynamics of the bond market. Stay with us. This is Bloomberg. Good morning.